Uh, Give YouTube link in the chat.
How to go to YouTube here? You will not comment on it.
Hello. Tell me. I'll tell you. Just I'm starting the seminar. Okay. As speakers have come, I will just get back to you. Huh? 8 o'clock we are international taxation conference, and I'm, so huh? Give me a few minutes. I'll call you at 8:15. Huh? Okay. Right. Bye. Santosh or Ram, can someone just open the video, please? There's a complaint that audio and video is weak. Ram, can you just talk so that I can listen to the voice?
Sir, can you hear me now?
Yeah, I can hear you because one Mr. Om Prakash Sharma has written that audio and video both are weak. I don't know. I'm just trying to clean the screen. Ram, can someone just open the video, please? Ram, do one thing. Audio and video. YouTube volume, you make it slow. Can you just talk so that I can listen to the voice?
Sir, can you hear me now?
I can hear you. YouTube volume, you make it 0. Your YouTube in your system, that YouTube also you are given a link. No, that should be made 0. Speaker of the YouTube. Now speak once. Good evening, Prasad. You have to unmute yourself.
Hello, Pankaj.
Hi, good evening and welcome. Your screen is looking very good, and your screen is looking good. You are looking good, and I think your audio is also clear to me. Someone
Okay.
just also put a comment if they are able to hear Mr. Prasad clearly.
Hello, hello. Am I clear?
Yeah. Yes, Prasad. To me, at least, definitely are clear.
So I will just share the. Shall I share the screen now or a little later?
Yes. Oh, welcome, Chaitanya sir.
Hi, Chaitanya. How are you?
Hi, Mr. Prasad. How are you?
Chaitanya has joined on.
Yeah.
Good.
Yeah, it's a pleasant surprise. In fact.
And I just thought I will wish Mr. Prasad and you all for a very successful seminar and take your permission to rejoin a little later.
No problem. No problem. As it suits
Happy
you.
to see you, sir. Thank you very much for joining.
Because if I were to join at 6:30, I may not be able to, speak to you. So that's why I thought I'll just
Thank you.
log in for about a couple of minutes. And
Good.
so
So how are things in Bangalore?
Bangalore, things are great.
And you are going for a hearing in the courts?
Yeah. So the hearings are happening, for the last 8 months. Very active.
Excellent.
If you could see the ITR, you would see a lot of cases being reported from Karnataka.
I know.
Mm-hmm.
Karnataka High Court has been always in the.
Yeah, it's quite. In fact, dependency is very less now. 2017 matters are being heard.
Oh, very good.
2017,
2017.
Yeah. 2000. They split it into 2 tax benches.
See, because at the High Court level, hearing just 3 years back cases is very heartening.
It's very good. No, 3 years back. No, it's not 3 years back cases. The appeals filed in 2017.
I know. What I mean to say, filed in 2017.
So obviously it should relate to 12, 13, 13, 14.
That's fine.
Yeah.
The matters which have come filed before the court in the year of 17.
Yes.
So anyhow, so we're all eager to hear you also.
No, you have already cautioned me not to, make it complex. So
yes.
challenge is to make it.
It should reach out to all the members. Juniors, seniors,
challenge is to make it as simple as possible.
I know.
Because our specialization is thriving in complexity. So lawyers tend to make things more complex than what it is. You've asked a lawyer to, unwind his threads and. Yes, sir. So
Pankaj, you can always go ahead as per your schedule.
Yes. So
just waiting for sharp 5 because Hyderabad they generally know that sharp 5 is start.
No problem.
Yeah, that's fine. So you can. Yeah. So Mr. Prasad, all the best to you. I'll join maybe a little later.
No problem.
And thank you, Mr. Pankaj, and all the best to you all. Yeah.
Thank you, sir. Thank you for joining.
So I would leave now and re-enter.
No problem.
Yes, sir.
So same method of entering would help, right? I don't have to.
Yes.
Yeah. Okay. Yes. Right. Thank you. And I would have a PPT, which I would, once I enter, then, we could always, you will allow me to share the screen.
Yeah, it's already there, sir. Permissions are
I could see the share screen being enabled here. Okay.
Thank you.
Thanks. Yeah. Thank you very much. All the best. Yeah. Bye-bye. Thank you.
Could you go there, sir?
Sure.
morning, could you visit or no? Could you visit him?
No. I could not go.
I could just go in time.
Okay. And you went to their house? Okay. Before they are moving.
Just, I think, 5 minutes to 6 minutes.
No, I could not do. I would talk to Sairam tomorrow. Sairam is in the same building, in fact, where our office is there.
Oh, I think then Vijay Raghav is also working there.
Huh?
Vijay Raghav, one more chartered accountant. I think.
Who is he with
Sairam.
Sairam is son of
Sairam.
Rao.
No, Sairam. Under Sairam. Capital Fortunes.
Capital Fortunes, exactly. Because he is not in regular practice. No, he runs a separate company and all. So my profile is already there, she told.
Pardon?
My profile is already there.
It's there. I'm wondering what happened to Deepak Bulke. He's...
Start out on 5 to 6:30.
Yeah, it's 5 o'clock, Prasad. Can we start, Prasad?
Yes, sure.
Yeah. Thank you. Good evening, everyone. Like respected Prasad, speaker of the day, and all the participants of this seminar. Friends, yesterday was a very sad day, not only for the Hyderabad branch, but also for the entire ICA, as we lost a very senior, highly respected, immensely professional, and a visionary leader, Sri M. Bhaskar Rao Garu. To be very honest with you, I wanted to postpone this seminar as a mark of respect for Bhaskar Rao Garu. But 31st January is the last day for members to complete their mandatory CPE credits, and cancellation of this program could have negatively impacted some of our members. Knowing Bhaskar Rao sir, who always had the welfare of our members in his heart, I felt that the best way to pay the tribute to Bhaskar Rao Garu would be to continue with our work so that the members are not deprived of their CPE credit. So I just decided to continue this seminar, decided to dedicate this seminar to CAM Bhaskar Rao Garu. And I feel that maybe wherever he is, his blessings will always be on the CA fraternity. So, with this, friends, I would like to welcome all of you once again to this seminar on international taxation. Friends, today, as usual, whenever there is a seminar or conference on international taxation, Hyderabad branch of SIRC of ICA is very, very lucky because we have Mr. PVSS Prasad, who will do everything for us. I don't think the easiest job for any chairman to do in Hyderabad would be to have an international taxation seminar, because you just tell Prasad sir, we want to have a seminar, and he does everything for us, right from fixing the speakers to being one of the speaker. In fact, that we force him to be one of the speakers, and the way he follows it up, I consider myself very fortunate to work under him as vice chairman in the year 1999. Okay, so Prasad sir, what we'll do is Deepak Ladda has joined, and Deepak, are you there, or shall I? Okay, what we'll do, Prasad sir, is I'll not give lengthy speeches now, and I will leave it to you. I'll first introduce Prasad sir, and then I would request Prasad sir to continue. So, friends, it's my privilege to introduce CA PVSS Prasad sir, who is a practicing chartered accountant and an information system auditor, and is a partner of Mrs. Prasad and Prasad Chartered Accountants, Hyderabad, since 1986. He is the past chairman of Hyderabad branch of ICA. He is the past president of the AP Tax Bar Association and the past chairman of the International Fiscal Association, Hyderabad subchapter. He co-authored a book titled International Taxation, a Basic Study, published by Book Corporation, Calcutta. He was appointed as one of the branch reporters for IFA Congress 2010 that was held in Rome, Italy, on the subject tax treaties and tax avoidance, application of anti-avoidance provisions. He was the chairman of All India Federation of Tax Practitioners, South Zone, for the term 2010-11. He was co-opted member of the Committee on International Taxation of the ICA for the year 16-17. He was invited to speak at IFA Asia Africa Conference held in Mauritius in May 12, May 14, and May 16. He was invited as a panelist at the Asia Pacific Regional Tax Conference 2016 held in Seoul, South Korea. He is a regular faculty for the diploma course on international taxation of ICA. He is a co-opted member of the Committee on International Taxation of the ICA for the year 18-19, and he was a vice chairman for IFA India branch for the period 2018 to 2020. So I very proudly present CA PVSS Prasad to the august audience. Mr. Prasad, it's over to you.
Yes.
And you say, thank you.
Yes. Thank you, Pankaj, for a very generous introduction. And in fact, there's no such formality, but anyhow, it's a very generous introduction. And thank you very much, all of you, to be part of this international tax webinar. I would like to just share screen my presentation. So friends, today we are going to discuss about the concept of place of effective management. And this is a concept which is very much prevalent in the tax treaties originally. Now it has made inroads into the domestic law, tax law, since 1718 assessment year. So we need to really know what this concept is. This is meant to decide the residency of non-individuals, more specifically with the companies. In fact, as you know, for individuals, if at all an individual is a resident of US as well as India, We have many popular cases of individuals who are Indian residents have shifted to US for a long time. They stayed there, they have become residents and even citizens there, and they have returned to India for a good, say after 30 years or 35 years. Then there is always a dual residency conflict, because in the international taxation, your residency must be identified with only one country. It can't be identified with several countries, for the simple reason that there should be only one resident country and there could be any number of source countries. Source countries in the sense, when you consider the global income for taxation of a resident of India, he could have had a source in US, he could have a source in UK and other places, but he continues to be a resident of only India. Why this is required is because in the international taxation, the taxes are shared by jurisdictions. To put it very briefly, for want of time, that is the basic concept. That is how the double taxation is avoided. Suppose you earn a particular income running your business in the form of a branch in US. US will have the first taxing right because your branch is located there in US, and you are using the public infrastructure there, and whatever taxes that are levied by US as a tax jurisdiction having its first right to tax you would be given as credit by India, being a resident country, because you belong to India and you are resident of India, and India has to administer the tax credit. When they consolidate the income here, the income earned abroad also, along with the income earned in India, then the taxes paid in the source country like US would be given as credit in India, India being a resident country. So that is the reason whenever there is a dual residency, it needs to be resolved, and that particular individual needs to be identified as a resident of one of the countries and not both the countries. Taking the popular example for your easy understanding, a person who lived in US for 30, 35 long years and who has become a citizen there and who has come back for good and now started staying here, and he came back for good and he was here for more than 2 years and he continues to be here and he becomes a resident, an ordinary resident as per section 6. Then he is resident here and also resident in US because he did not surrender his citizenship. There, the residency is based on the citizenship and not on the basis of a physical stay of the taxpayer. So on account of this, a typical situation arises whereby a person, an individual, I'm talking about an individual for our easy understanding to start with, an individual would be treated as a tax resident of both India and US, which needs to be resolved through a tie-breaking rule which we have got in the India-US tax treaty as per the Model Convention rule. The tiebreaker rule is they will first look at the permanent home where you have a permanent home. If you are having a permanent home in both the countries, then we'll move to the next level of tiebreaker where you have a habitual abode. Then where do you have the more economic interests and cultural interests? And then if these tests are not resolving the issue, and we'll look at the nationality, to which country you are a national. Because every citizen is a national, but every national need not be a citizen. So that is what is decided by the Supreme Court in the State Trading Corporation. So nationality is a bigger set, and citizenship is a smaller set. Every citizen is obviously a national, but every national need not be a citizen because he could be staying elsewhere in the other than his own country. So as how we have a tiebreaker rule to decide the dual residency conflict, we also have a tiebreaker rule traditionally in the OECD Model Convention and also in the most of the tax treaties India has signed, that is the place of effective management as a tiebreaker rule to resolve dual residency for non-individuals. Non-individuals, mostly it could be corporates and it could be anything other than corporates and not an individual. So we are now more concerned with the company taxation because Section 6.3 is what we are going to deal with now. So this concept is originally there in the model convention, and then that concept now has been brought into the domestic law since assessment year 2017-18. In fact, this concept was discussed when there was an amendment 2-3 years back. Now much what has flown under the bridge, and now all the tax treaties are getting modified on account of the multilateral instrument, and there are so many developments that have come. We need to really update with the developments what are happening on the international tax arena. Mr. Pankaj, am I clear? The voice, everything is clear?
Yes, Prasad, everything is clear.
If any problem is there, immediately let me know.
I'm here, I'll take care. Don't worry about it.
Yes.
Thank you.
So the definition what we have regarding the residential status of a company, as how we have residential status under Section 6.1 for the individuals, we have for the company. This is what we had prior to 2015 when this amendment came. Okay, so a company is said to be a resident if it is an Indian company that is registered in a domestic company, or during that year, the control and management of its affairs is situated wholly in India. That wholly is very, very important, because that is what has given a lot of leverage for tax planning to so many corporates incorporated outside, though they were literally managed by the Indian promoters, like having a company in Singapore, having a company in Mauritius, having a company in UK, but virtually that is managed from India, except making or shifting little management outside India to UK, like holding some of the board meetings, 1 or 2 board meetings in a year outside. Like that, by doing or shifting little part of their management to abroad, they were able to manage and get the status of a non-resident and not being treated as a resident in the past. So to check this abuse of law, and also to bring in the most popular concept of place of effective management as a rule to decide the corporate residency, the POEM concept has been brought into the domestic law as how what we have under the treaty law or under the model convention. So the amendment that has come, that is the amended definition of the residential status of a company, which is originally supposed to have applied from 16-17 assessment year, for want of clarity and for the purpose of issuing proper guidance, CBDT has postponed the application by 1 year, and it was made applicable from 2017-18 assessment year, though the amendment has come through Finance Act 2015. See, the amendment goes on to read like this: a company is said to be a resident in India if it is an Indian company. That is there in the past also. Now in the second limb, where originally we had the control and management to be wholly in India, now is being replaced. Its place of effective management in that year is in India. If at all its place of effective management is in India, then the tax authorities would be entitled to treat that foreign company. See, in most of the cases, these companies are subsidiaries of an Indian holding company or Indian parent. So the tax authorities would be entitled to treat such foreign company, which is a subsidiary, mostly. It could be another foreign company also, which is not a subsidiary. But the targeted group is the subsidiaries, which are nothing but shell companies, which are being, widely used, abusing the then existing law to shift profits and not getting taxed in India. To check that, this amendment has come, which says, if at all it is proved that the place of effective management of such foreign subsidiary or a foreign company is proved to be in India, then it would be treated as resident of India. Then what are the consequences? Once you are a resident of India, the company's entire income, global income, would be taxed in India. That is the most undesirable consequence for a taxpayer. This is where a lot of concerns have been shown by all the corporate players, including PSUs. In fact, when this amendment was moved in 2015, I remember very well, ONGC has gone on record in a press release stating that almost 14 to 15 subsidiaries of ONGC, which are abroad, which are virtually operated from India, would all be hit by the amendment. That is what ONGC has told in its press release, ONGC being a PSU. So whether it is a PSU or a private sector company or a multinational company, whatever it is, this concept has been brought in line with the concept we have under the model convention. This is a concept to decide the corporate residency. So this is what you need to bear in mind. And then what is POEM? What is the definition where the explanation goes on to define? Place of effective management is a place where key management and commercial decisions that are necessary for the conduct of the business of an entity as a whole are in substance made. So we will have to locate and identify whether such place is in India. If at all such management and the management place where decisions of key management and commercial decisions are in substance for the entity as a whole are made in India, then that foreign company would be treated as having POEM in India, thereby it would be treated as a resident of India as per the amended provision of section 6.3. So having got this explanation, we need to move and see how, it has to be understood what is POEM. In short, we'll call it place of effective management, that is POEM, POEM, POEM. So before getting into POEM per se, against which we need to have some more case law that has to come up, but we will look at the jurisprudence, what we have in the context of the earlier domestic law, where control and management criteria was used to decide the corporate residency, which we have discussed a little earlier. And we have Subbaya Chettiar's case reported in 19 ITR, where it said control and management signifies the controlling and directing power. The head and brain situated implies the functioning of such power at a particular place, which carries out the real performance of the company's activity. That means they will look at head and brain. Where the head and brain are located, that is the place where you need to identify as the control and management, and thereby you will say that is the place where the corporate residency needs to be established, which needs to be identified. The same way, Nandlal Gandalal also, 40 ITR Supreme Court, control and management signifies controlling and directive power, which signifies the head and brain as it's sometimes called. Furthermore, the expression control and management is a de facto control. That means it's not de jure control. De jure means just passing a resolution stating that one person CEO sitting in Mauritius will manage the whole company. That resolution will not do, if at all. The real owners of the company are sitting in India, and the real directors who have the power to control the company are sitting in India, are issuing directions from India. Then the head and brain would be treated as being located in India. That is what has been, and the de facto power is more important and not the de jure. That is more important. And Nandlal Gandalal and Narottam Perire's case, as a Bombay High Court, and Saraswati Holdings case, that is 2007. Also, they said, the entire management must be in India. If at all, even part of the management is not here and it's outside, that is good enough to treat the corporate as a non-resident and not to be treated as a resident. And Radharani Holdings case is on a similar footing, where the Indian promoters have a company in Singapore, and virtually they are managing the whole company sitting in India, except having one or two board meetings there, and that board meetings conducting conducting such board meetings in Singapore alone has helped them to claim non-residency for the company, and thereby they have escaped that company's taxation in India. So there is a clear Radharani Holdings and Saraswati Holdings have real. These are the two judgments delivered by the Delhi Tribunal and Delhi bench of the tribunal, which has really upset the revenue authorities, and they have come with the concept of a poem much later, of course, not immediately, but definitely in 2015, they have brought in the concept of poem to check such abuse and ensure that real foreign companies are only to be treated as non-residents, which are really effectively managed from outside India, and not those shell companies or subsidiaries which are virtually managed from India, but for the namesake registered outside India, be it the Mauritius, Singapore, UK, Cyprus, anywhere. But if at all the effective management in India, then definitely the tax authorities would go by the present criteria of a poem and then identify such company as a resident of India, and it would be followed by the consequences. And what is the concept of poem now as per the new definition? Because when the poem concept has come, now a lot of debate has happened. How, what is the criteria, what are the guidelines that CBDT has to issue for us to understand what is poem, and for us to ensure that bona fide companies are not impacted by this definition, which are unintended target group. So this is where a lot of clarity was sought, for which reason even CBDT took one long year. They have invited all the comments from the stakeholders. That was the reason the implementation has been postponed by 1 year, and it was made applicable from 17-18 assessment year onwards. So now let us look quickly at the wording used in the definition of a poem in the explanation to section 6.3. Effective means producing the result that is wanted, we all know, and management, the process of managing or being managed, the action of managing, and the professional administration to run business activities, as mentioned in the illustrated Oxford Dictionary, the act of managing by direction or regulation or administration or control or supervision. And this is all Wharton's law lexicon and all that. And key, what is the key? Key means the most crucial, main, significant, and vital and strategic decisions. The decisions which really impact the business functioning and the profit-making activity of the business is what needs to be looked at as the key decisions. And commercial, as we all know, have engaged or concerned with the commerce having profit as the primary aim. As a whole, you must look at this in a comprehensive manner and don't look at isolated facts and arrive at a decision that poem is there here in this country or outside. Poem must be decided on a comprehensive manner. That is what one needs to bear in mind. In substance means not the form, but you should look at the substance and see really where the control is happening, where the effective management is happening. That is what we need to decide. Poem has been defined to mean a place where key management and commercial lessons that are necessary for the conduct of the business as a whole, which are made, is what we need to identify with respect to each case separately. And Income Tax Act says place where the key management and commercial decisions that are necessary for the conduct of the business of an entity as a whole are in substance made. That is the definition we have. And set of guiding principles have been issued by CBDT on 24th January 2017, which will run through the key components and salient features of the guidelines a little while from now. And OECD commentary also talks about the key management and commercial decisions which are in substance made, and the location and place where such decisions are taken is to be identified as the place of effective management, the poem. And it is widely accepted that there could be many places of management, but there could be only one place of effective management. Company could have many places of management, but there could be only one place of effective management. Even that is what is mentioned by CBDT in its circular number 6 of 2017 also. And in fact, UN commentary also talks about a place where the company is managed and conducted, where the decisions at the highest level are taken, which are very essential for running of the business from the economic point of view, and where the important books of account are kept, where head office is there. These are all the criteria to identify, to evaluate and identify where the place of effective management of the company is located. So these are the key components of a poem where board meetings are done. See, generally the board meetings, I mean, that is where the most critical and strategic decisions are taken, and key managerial decisions, and CEO and executives where the the key management professionals are sitting. Let it be a CEO or managing director where he is sitting, and headquarters, where is the headquarters located, where are the accounting records kept, where is what is the legal status of the company. All these criteria needs to be looked into to arrive at where the poem is located. The poem is a very fact specific determination, and all the factors would need to be considered. That is the reason you need to bear in mind that you must have a comprehensive view of the poem, and you cannot decide poem on the basis of isolated facts. You need to look at the overall functioning throughout the year. It is not at one particular point of the year, but the entire year you must consider and see whether the poem lies in India or a poem lies outside where the company is registered. So this is what needs to be done. And the concept of poem in terms of Article 4 of the tax treaties, several Indian tax treaties already have this. That's what I mentioned. India has got more than 95 tax treaties which are signed. And in respect, in Article 4, relating to corporate residency, whenever there is a dual residency for corporates, the tiebreaker rule is the poem. That is what we have before the MLI came into existence. MLI has become a reality from 1st April 2020, which we will discuss little later. What is the impact of MLI on this concept we will discuss. So keeping MLI aside for a while, what is there already in the tax treaties, and we need to know. And there is no definition generally given about the poem in most of the treaties, except few treaties like India Belarus tax treaty, where the poem is defined in a protocol. What is a protocol to a tax treaty? Protocol is an amendment. As how we have amendments to the income tax law year after year, protocol means in the international tax parlance, it is an amendment to the existing tax treaty. Through a protocol to India-Belarus tax treaty, poem was sought to be defined as a place where company is actually managed and controlled, the place where the decision making at the highest level on important policies, essentially focusing on the company's performance, takes place, and the place that plays a leading part in the management of the company from an economic point of view is what is the place of the poem, and place where the relevant accounting books are kept. So these are all the criteria which you need to bear in mind as per the definition which is given in India-Belarus tax treaty, which will apply only in that context and not in the context of any other treaty. But just for most of the treaties have not defined what poem is. So when you please bear in mind, if at all there is no definition in the tax treaty for a particular term, then what is the process of interpretation? You need to look at the domestic law of the source country where the treaty is being applied. Suppose a non-resident from US comes to India and makes an earning in India, and he has a company and and his company is trying to operate from India, and there is a issue regarding poem. Let us say whether there is a poem here in India, then because there is no definition of poem in the tax treaty, what you will do? You will go into the domestic law. Which domestic law? That is the domestic law that is the source country. In the example I have given, it is India. So India also, whether the domestic law doesn't have a definition of poem till 2015. Only in 2015 we have an amendment now. So prior to 2015, there was no definition. Then we will go with the international fiscal meaning. That is the process of interpretation under the tax treaties for a term which is not defined in the tax treaties. So that time we used to get along with the concept what is understood as per the commentary given by OECD against the term place of effective management. But now there is always now the Indian tax authorities can always say that we will try to apply poem as per the domestic law because we have a definition here in our domestic law which is brought in through an amendment in 2015. Be that as it may, because the poem concept is there already as a tiebreaker rule in Article 4.3 with reference to non-individuals covering corporates, and also you have Article 8 dealing with shipping and air transport. As you know, a ship makes voyages and touches many countries and reaches its own country, and it goes around various countries across the globe. And the same is the case with the airlines. See, both these activities, you cannot say that they have residence in every country where they have a business, where they have passengers. That is the reason Article 8 very clearly provides that it is only the residency of a shipping company or an air transport company would be the country where they have a place of effective management, and it's not in any other place. So in that context, whether it be Article 8 or the poem as a tiebreaker rule under Article 4.3, we have these plethora of judgments coming in the NatWest case where it was held. We'll have to see where real management is happening. Refers to the place from effectively the day-to-day affairs of the company are carried out, not the place in which they reside. The ultimate further the BOD meetings, the board of directors meetings and general meeting of the SSC were held at the registered office of the SSC. In that particular case, in NatWest case, it was held in Mauritius, and so accordingly, it was held that the poem is there in Mauritius and not in India. And same way we have 224 ITR AR ruling also is there, and we have Mauritius Investment Company's case and SMR Investments Company. All these have proved that the management is outside India, and accordingly, poem is outside India. Whereas in Perel Logistic Director that is a Denmark company, there also it is proved the poem is outside and not here. But one of the this SMR investments order given by an Indian resident shareholder via telephone for sale of investments held by Mauritius entity. Though the investments are held by Mauritius entity, the promoter of such Mauritius entity is a resident of India, sitting in India, he manages the whole show, and that is good enough to come to the conclusion that the place of effective management of the Mauritius entity is in India and not in Mauritius. This is how we have some jurisprudence coming to our rescue for us to understand what is the concept of poem under the treaty law. And then let us look at the poem guidelines. What are the guidelines given by the CBDT for us to evaluate, examine, and understand the concept of poem when we have to apply as per Section 6.3 of the Income Tax Act now? The poem, these are some of the key and salient features of the guidelines. Guidelines are released in the form of Circular number 6 of 24th January 2017. The poem concept is one of substance over form. It is not just the form, but it is the substance over form. The determination of poem depends on the facts and circumstances of a given case. An entity may have more than one place of management, but it can have only one poem at a time. That is what even explicitly mentioned by CBDT in its Circular number 6. There could be many places of management, but there is only one place of effective management, and it can be at many places. Determination of the poem, since the residency has to be checked of an individual every year, the same is the case with the corporate residency. The poem concept needs to be evaluated year after year. It's an yearly exercise you need to do. There could be a poem for a particular foreign company in India this year. There could not be a poem in the next year, if at all it's not operating from India. So it's a year-to-year exercise which you need to do, and determination of poem would be primarily based on the fact whether or not the company is engaged in active business out of India. First of all, for us to arrive at a decision that this company, being a foreign company, is also a resident of that country. That means if at all there is an active business for that company outside. If it is just a shell company, if it is just an investment company, it is not doing any active business, then that itself will bring some sort of tainted image, and then the tax authorities would have to check whether that particular shell entity or an entity which is only earning passive income and not active income like business income, then all the guidelines, all the criteria would be applied to decide whether it is its poem is in India or outside India. But once the company is running active business, there you are clearing 60 to 70% of the test because you would not be treated as a resident on account of poem in India. It's a broad approach I'm telling, I'm not deciding. But when once you have an active business outside India, that means the entity outside has got the substance. There is a commercial relevance. There is a commercial justification to treat that company as a resident outside India because it has all its activity outside India. And determination of poem would be primarily based on the fact whether or not the company is engaged in active business. That is what I mentioned. And coming to determination of poem is based on all the relevant facts rather than isolated facts. That's what I mentioned. You need to look at the entire year under consideration. It is not a particular point of time in the year. It's not a few days or 1 or 2 months you need to see. You have to look at the entire period as a whole and take a comprehensive view whether the company is effectively managed from India or outside. The principles for determining poem are only for guidance purpose, and no principle is decisive by itself. No single principle is decisive. That is what these are all the statements made in the circular by the board. Where poem is determined to be in India and also outside India. Again, at the end they are telling, though they said poem can be only at one place, at the end they are telling if at all the poem is there in 2 places, the predominant activity and the predominancy will come into play, and we'll see where you have a dominant activity, where you have the dominant presence. That would decide if at all the dominant activity is in India, then definitely the poem would be in India. That is what is mentioned in the guidelines. So this is a process which I have given for your easy understanding, which says how you have to go about, and a company is engaged in ABO. ABO means active business outside India. And if majority of the meetings of board of directors are held, BOD means board of directors, are held outside India, then it is the poem is outside India and it is not to be treated as a resident of India. If at all it is not an active business, then comes the problem. Then you need to establish that your poem is outside and not here. A company not engaged in an active business outside India, the determination of the poem would be a 2-stage process. What is the 2-stage? You will have to identify in the first step who are the persons calling the shots, who are the persons taking the most critical decisions, where they are located. That is important. Where they are located and from which place they are operating, from which place they are taking all these decisions. These are the issues. This is the 2-stage process which you need to see. If at all, on the basis of that 2-step or 2-stage process, suppose it is decided that the key management and commercial decision as a whole are made outside India, then the poem is only outside. If at all it's made from India, then poem is in India, and that foreign company would be treated as a resident in India, and the entire foreign company's global income would be brought to tax, which is the most undesirable consequence. Sometimes the board of directors would stand aside and give the power to a committee or an individuals, set of individuals. then you need to look at the substance. Just because board meetings are held outside, that is not conclusive. If at all the board is simply endorsing what this committee is doing or what these individuals are doing, then the place of management is where these committees are operating or these individuals are operating and are located, and not outside where the board meetings are happening for the namesake. So that is what we need to bear in mind. Then, for us to decide how to come to conclusion that a company is operating an active business outside India. For us, the criteria given by the circular are: the passive income is not more than 50% of its total sales. That is passive revenue. What is passive revenue? Passive revenue, they have defined to be like royalty, dividend, interest, rental income, so and so, and also capital gains, and also transactions with associated enterprise also is treated as a passive. Though it's a business transaction, though you are making sale of goods, though you are purchasing goods, if at all you are buying and selling again to them, if you are just buying and selling it to an outsider, it would not be counted as a passive income. If at all you are buying and processing and again selling back to them, then it is to be treated as a passive income and not to be treated as an active income. Then assets of the company, what are located in India, though it's a foreign company, there could have been some assets in India. Such value of the assets must be less than 50% of the total asset value of the company. Same way, number of employees located in India should be less than 50% of the number of employees of the overall company. And the payroll expenditure also, with respect to such persons located in India, such employees located in India, it must be less than 50%. Not only the number, not only the quantity, but also the quality. That means not only the numbers, but also the pay packet and the payroll expenditure. The overall payroll expenditure must be less than 50%. Suppose you have, say, 25 employees, out of whom 3 key professionals are in India. Number-wise, you might say more than 50% are there outside. But when you come to the payment angle and the payroll expenditure, what is being paid to these 3 professionals, these 3 key management professionals, they could be promoters also. It could be 70% of the total payroll expenditure. Then you will have to decide that the poem is in India and not outside India. And board of directors retains and exercises their authority. Then it is the place where board of directors meetings are held. That could really throws light and direction as to what is the place of effective management. If at all such board meetings are happening outside India, and then the poem could be outside India and not in India. If at all the board is not taking critical decisions, board is just running for the namesake, and the board of directors have delegated the authority to senior management, be it be a managing director, or be it be a CEO, or be it be a COO, whoever it is. If at all they are operating not from the place where board of directors meetings are held, but they are operating from, say, from India, then there would be a problem, and we will have to look at the substance of the transaction and then decide that it is not there in that country where board of directors meetings are happening, but it is in the place where these key professionals are located and running the corporate. And committee, there could be a situation where it could have been delegated to a committee, and the committee is sitting in India. Then also there is a problem, though board of directors meetings are happening in Mauritius or Singapore or Cyprus, that won't help, because the committee is the real power center which is operating from India, and then that can clinch the issue and decide the corporate residency to be in India on account of poem being in India. So then comes this centrally located. They are based in a single location at a place which is identified as a head office. Then if at all it's the real head office where the managing director, everyone is there, then the decisions are taking place there, then it is that place which is to be identified. If it is decentralized, they operate from different offices located in different countries, then the location where the senior management is primarily predominantly based, normally return after travel to other locations. See, where they are getting back to their own work, they travel across the world, they come back, where they are coming back, which place, that place needs to be identified as a place of effective management. And further decentralized, suppose location where the highest level of management is operating, that is what we need to look. And highly decentralized, location of the head office will not have any relevance, because head office is the namesake, but actually it is decentralized across the world. And then we need to really go by the fact pattern and see where it is operating. Meetings via telephone, video conferencing, place where the directors or the persons of majority of them usually reside. That is the most important. Suppose the entire the board meetings are happening through video conferencing, then where this crucial personnel, that is, I mean, the key directors or the CEO, managing director, where they are located, that would be the place of poem, and that would be the critical place for consideration. And circular resolution or round robin also, there is some sort of guidance given. And matters which are reserved for shareholder decision. Generally, the shareholder decisions happen in the company only for items like sale of all substantially, the company assets, dissolution, and modification of rights attaching to various classes of shares and all that. So these routine matters would not constitute effective management. Okay, so these meetings, the place of those meetings would not decide the poem. But when shareholders take over the real management from the board, either formally or by shareholder agreement, then there could be some cases where shareholders would try to manage in times of difficulty or whatever, in times of extraordinary situations. Then you will have to see where these meetings are happening, which really constitute the effective management. That is what you need to look. And day-to-day management does not really decide the effective management. Day-to-day management is not the criteria to decide the effective management, because a decision by a plant manager to run the facility and appointing an officer, an executive in his own department, decision concerning repairs and maintenance, decision relating to the implementation of the company regarding quality control. These are all the routine functions, day-to-day functions, which cannot be treated as effective management or poem. Examples of key management and commercial: decision to open a major new manufacturing facility, or a decision to discontinue a major product line. These are the major decisions which have impact on the entire overall business activity of the company. The operations decisions relate to the overall business and activities of company management. Commercial decisions are the strategic and policy decisions. That is what we need to look at to decide the poem, not the routine operations. If all the above discussed factors are not able to decide, if we are not able to decide on the basis of these above factors what we have discussed, then place where the main and substantial activity of the company is carried out needs to be identified. Place where the accounting records of the company are kept needs to be identified. So these would throw light on where the real poem is there. And some isolated factors cannot decide the poem, like ownership. Suppose the Indian promoters are 100% owning a subsidiary outside India, be it in UK, US, Mauritius, Cyprus, Singapore, or anywhere. Just because the entire shareholding is held by an Indian resident, that itself cannot constitute a poem for that foreign company in India. No. The real management also should happen from India, effective management. Then only poem is said to be in India, otherwise not. Same way, the foreign company would have got a permanent establishment, would have got a branch here. If at all there is a branch, there is only a permanent establishment, only to the extent of those branch profits would be taxed in India and not the entire income of that company. If at all POEM is triggering, that means the foreign company's entire global income would be taxed in India, which is the most undesirable consequence. So just because that foreign company has got a branch or which is otherwise known as a permanent establishment under the international tax parlance, just because the foreign company has got a PE, you can't say the foreign company's POEM is in India. No, that is wrong. And directors, residents, some of the directors are in India. That doesn't mean that POEM is in India. You need to establish the entire real effective management happen from India. Then only the corporate can be, the foreign company can be viewed as a resident of India. The local if at all there is some regional management for a large group, the regional management, regional headquarters, there is a circular issued in October 2017 clarifying that regional headquarters of large corporations cannot per se trigger POEM for large corp, because a lot of concerns were expressed by stakeholders stating that large multinationals who really operate with substance, they would have got their regional headquarters in India. Then you cannot come to a conclusion stating that let us say GlaxoSmithKline or some large pharma company or foreign company, they have some headquarters, let us say regional headquarters in India, that cannot decide the issue against them holding a view that POEM is in India. No. And support activities carried out in India also, auxiliary and preparatory activities cannot clinch the issue of POEM. And the circular has also given some checks and balances before considering the POEM of a foreign company in India. A SING officer himself cannot do, first of all, before initiating the proceedings, he must take the permission of the concerned principal commissioner and then initiate his examination or investigation. Then before invoking POEM and taking a view that the foreign company has got a POEM in India and it is to be treated as a resident in India, he has to necessarily seek prior approval of a collegium of 3 members who are of a rank of commissioner or a principal commissioner, and all are revenue members only. There are no outside members as per the guidance given in Circular 6. And the collegium will also provide an opportunity to the to such foreign company of being heard before adverse directions are being passed by the AO. Unlike GAR also we have a panel, approving panel, where High Court judge is one of the, he would act as a chairman, and there would be a revenue member. There is also an academician coming from outside. It's a very well laid out panel under the GAR provisions, but unlike GAR, here the panel would be headed by all 3 commissioners of the department only. No explicit requirement of providing copy of the directions to the SSE. When they pass direction, the directions need not be made available, and possible to invoke a writ jurisdiction. If at all the foreign company is adversely impacted, it can go under writ jurisdiction. That is the only recourse. And global income, taxable in India at the rate of 40%. Then what are the consequences? If at all a foreign subsidiary of an Indian company is treated as having POEM in India, thereby it is treated as a resident in India, then what are the consequences? Consequences will follow as per section 115JH. Please go through 115JH, which again, the import of 115JH has been brought in the form of a notification issued by central government on 22nd June 2018. So global income continues to be taxed at 40% like a foreign company. So it's a blow hot, blow cold situation. Though it is a foreign company, though it is treated as a resident of India, then you can say when it is treated as a resident, why can't you apply the same corporate tax rate which is applicable to a domestic company? No, because basically it is a foreign company. We continue to tax it at the foreign company tax rate of 40% plus surcharges and all that. There is no concession to that. Applicability of TP provisions, they continue to apply. Suppose there are transactions between the parent company in India and this foreign subsidiary, that would still undergo the TP implications. You cannot say because the foreign company subsidiary has become an Indian resident and the transactions between the parent and subsidiary which has become a resident of India are domestic transactions in there, and you cannot argue that TP would not apply. No, TP continues to apply, and you need to comply with the provisions of transfer pricing regulations. And withholding tax provisions in section 195 continue to operate unless payment falls within the source exclusions under the domestic law. If at all there is any exemption, source exclusion, that alone will help. Otherwise, the withholding tax provisions will apply. That is 195. Compliance in form of filing ROI, return of income, TDS return, equalization, everything will apply. Interest and penalty in cases where poem is determined in India during tax hearing. Suppose during the tax proceedings, the tax officer comes to a view that the foreign subsidiary of an Indian parent is to be treated as a resident of India, then he will invoke poem concept and then make such a company a resident of India and accordingly apply all the provisions, because the provisions would be applied during the assessment proceedings for a year which has already which has already elapsed and which is a past year. Then definitely the penal consequences and the interest liability would arise in respect of the tax liability. And computation of income of the foreign companies turning first time resident in India is to be dealt with by section 115J. What I told you should be read along with the notification dated 22nd June 2018. When you go into the circulars, portion of the database of CBDT, you will have this notification. You can download this notification and it would give you, the procedure how to apply the transitional provisions to a foreign company which is identified as being covered by poem concept and thereby treated as a resident of India. Then what are the consequences? It's very clear. It's something like depreciation. When once global income is going to be taxed here and they are going to consider the WDV, that is the written down value of the assets, as per the tax assessments happened till last year abroad, that would be taken as a WDV value. If at all there is no tax assessment there, if at all there is a tax exempt company, then the opening book value, that is the written down value at the opening of the year, at the beginning of the year, would be considered. And the same way, past losses and unabsorbed depreciation would also be considered from the tax records of that country the previous year. If at all there is no tax assessment, then that is as per the books of account. Tax withholding provisions applicable in case of conflict, withholding provisions applicable to non-residents would prevail. If at all there is a conflict between the provisions, which provision to be applied, provisions as per the domestic law and provisions as per the non-resident law, that is as per section 195, the non-resident provisions would prevail over the domestic law provisions. Foreign company entitled to relief of deduction of taxes, whatever taxes that are already paid abroad, that is in their country where it is registered, would be given credit as per section 90. That is one saving grace, whatever taxes that are paid would be allowed as a credit here. But the company continues to be taxed like a foreign company at 40% along with education cess and surcharge and not at the domestic company tax rate. Then we are coming to the end of the discussion. Then we can have 10-15 minutes interaction. Please go through this provision which I have. This has come through multilateral instrument. I'll just sip. I'll just have a glass of water.
In between, anyone who would like to ask questions, they can just put it in Q&A. Depending upon when the session is completed, we can check if Prasad sir would like to take the questions as of now or after Chaitanya sir's session is completed. Thank you.
So you would have read this Article 4.1 of the MLI. What is MLI? Multilateral instrument is signed by as many as 100 countries today, more than 90 countries. MLI is the culmination of all the action plans brought out by OECD and G20 countries. India is part of G20. India actively participated in the OECD BEPS agenda. BEPS agenda, what is BEPS? Base erosion and profit sharing. OECD BEPS agenda is nothing but bringing in anti-abuse rules to check tax leakages and rewriting the international tax rules. In the process of rewriting the tax rules, which have become redundant, one of the areas of tax abuse identified by OECD BEPS agenda group, inclusive framework, is dual residency of corporates also. Because companies take this POEM concept to their advantage and ensure that their effective management is located in a country which is a tax haven, that could be, or a very highly tax friendly, taxpayer friendly country like Ireland, where you have taxes of only 12%, or it could be Cyprus where there is no tax, or Mauritius it is only 3%. Like that, the effective management of the company is managed to be shifted on account of the tiebreaker rule what we have under the existing model tax convention. So that is the reason they found and thought there is a lot of abuse happening on account of this concept, which is otherwise originally brought in as a very effective and a very upright approach to decide and resolve the corporate dual residency. So that is the reason now the concept is POEM is no more a tiebreaker rule in the model convention and also in the MLI. And the model convention also, whatever is brought in MLI, in the new model convention 2017 that has been brought. But you might say, all the existing tax treaties India has entered, POEM is there very much as a tiebreaker. Then how do you undo that? That is for what MLI has been signed, where you have Article 4, which deals in this manner. Article 4 provides that if at all a company has dual residency, then the dual residency is resolved not through POEM as a tiebreaker rule. POEM would be considered as one of the criteria, but it's not a conclusive criteria. The competent authorities of both the countries. Who are the competent authorities? Competent authority in India is the Joint Secretary Foreign Tax Division. He is the one who is empowered by the central government to negotiate tax treaties. The same person is also vested out with some dispute resolution powers. And the same competent authority will have to resolve this issue of dual residency. Suppose there is a dual residency issue between India and Mauritius or India and Singapore, then both the competent authorities have to sit, competent authority of Singapore and competent authority of India, and virtually always these competent authorities are part of the tax department or the revenue, part of the government. They are not outside arbitrators or anything. So the competent authorities alone will decide. So here, a lot of concern is being shown by the stakeholders, stating that when once you give power to the tax authorities, then the resolution process may be biased, favoring the revenue point, and it may not be unbiased. Doing justice to the taxpayer is what is the concern. But the impact of MLI, this is not a minimum standard. What do you mean by minimum standard? There are certain minimum standards and there are optional provisions. Minimum standards in MLI means every country must necessarily accept. Minimum standards are meant to check the treaty abuse which every country will accept. This is not falling in that category. This is falling in a lesser impacting category. So there is an option. Either you can opt or you need not opt. You will say, I am not going through this amendment through MLI. I will continue to have my old provision wherein poem is a tiebreaker rule. That rule alone I would like to continue. So that option is available. For example, India opted to go by this new rule, whereas Singapore, though it's one of the signatories of the MLI, Singapore said no, we are not subscribing to this Article 4.1, which gives power to competent authorities to resolve. We would still go only by the old concept of poem as a tiebreaker rule. So poem is no more a tiebreaker rule. That is what you need to bear in mind. As per the MLI, you need to check. Suppose if it's an India-Netherlands treaty, India-Mauritius tax treaty, Mauritius has not notified India as a Indian treaty as a covered tax agreement at all, then there is no impact of this change in the Mauritius treaty. Same way, US have not signed MLI at all, then there is no impact of this article on the India-US tax treaty. Netherlands has opted for this Article 4.1, like India. Then India-Netherlands tax treaty would get changed. If at all it is being governed by poem as a tiebreaker rule in the past, now it would not be. It would be governed by Article 4.1, which says the competent authorities would sit and resolve. Of course, they might consider poem as one of the criteria and one of the parameters when they conduct their own evaluation. Poem is no more a tiebreaker rule. Competent authorities of both states would resolve dual residency, and poem may be one of the criteria. These are the bullets which I have given for your understanding. This change is on account of abuse of poem concept in the past. So, India's domestic poem test prescribes an active and passive income test that is usually applied in the context of certain anti-avoidance measures like controlled foreign company provisions. CFC provisions are not there in India. CFC provisions broadly come up in a context where you have a subsidiary outside, subsidiary is making a lot of profits, and subsidiary is not an active income, it's only an investment company. And in turn, that investment company is having the operating companies in other countries. The entire profits of those subsidiaries is getting piled up only in this holding company, which is a tax haven, say Mauritius or Cyprus or some other country. Then in that case, you can apply this particular concept of CFC. So almost your poem concept is akin to CFC. That is the reason CFC rules are not brought in by India. We have brought in the poem concept, which by virtue of which you can check that abuse. And passive income and active income we have seen in the guidelines. What is passive income? If at all your passive income is more than 50% of your income, then you may not be treated as a company which is engaged in active business outside India. So that is the reason you need to carefully distinguish and decide what is active income and what is passive income. There is some guidance given in the guidelines, and it is also unlikely that India's treaty partners will be agreeable to dual residence of taxpayers resolved in favor, simply because now what happens when you both countries agree to this Article 4.1 of MLI, Article 4 of MLI, that is dealing with the dual residency of the non-individuals, then both will give the power to the competent authorities to decide. Competent, let's say India, Netherlands. Netherlands will engage its competent authority, and we will engage our competent authority. What our competent authority does, he will go by the definition of poem, what we have in the Act now under Section 6.3 and the corresponding guidelines. But whereas Netherlands, they might have different guidelines to decide about the poem, and they will say this is how this needs to be resolved. So there would be a conflict between both, and it may not get resolved. That is one of the most undesirable consequences. When these two competent authorities are not able to come to a particular conclusion, the taxpayer would have a very, very undesirable consequence in the sense the treaty benefits would not be made available to him. That is the most important thing. Treaty benefits are not made available to him except what are agreed to be administered by those two competent authorities again. So that would be the most undesirable consequence. And India's tax treaties with France, Singapore, Mauritius, and Netherlands and UK contain provisions similar to the language of the erstwhile 4.3. That means erstwhile 4.3 means where poem is a tiebreaker rule. Poem alone will decide where the corporate is a resident, if at all there is a dual residency. India's treaties with Sweden, Ireland, and Luxembourg already in the existing treaties, though poem is a tiebreaker rule, it also has got a provision to refer the matter to the competent authorities in appropriate cases for resolving dual residency of the corporates, non-individuals. And countries such as France, Sweden, Luxembourg, and Singapore have reserved their right. As I told you, this Article 4 is not a minimum standard, and you can have your own option whether to accept or not. So India and Singapore both have signed MLI, but India accepted Article 4 of of MLI, which gives power of reference to competent authorities, whereas Singapore has not accepted this. Singapore continues with the poem as a tiebreaker rule. Then what happens? When once your treaty partner has not accepted the new change, what you are trying to take as per MLI, when both have not accepted, that means you have accepted but Singapore has not accepted, then what is already there in the treaty continues to apply and there won't be any change. That means the poem would continue to apply as a tiebreaker rule. So take the example, this is the last slide of the presentation. Take the example in the light of MLI being a reality, and in the light of most of the countries signing MLI, like India, and MLI has come into effect for India and many other countries who have become signatories, especially these countries. Netherlands, as I mentioned, Netherlands also opted for Article 4, which says that, which results that poem is not a tiebreaker rule, and we will give the power to competent authorities to resolve the dual residency of corporates. Then, as I mentioned to you, India will try to project its own poem definition and guidelines as the criteria to decide poem where it is located. But whereas Netherlands may do it as per their domestic law and their approach, there would be a conflict. Thereby, what happens if these two competent authorities are not coming to an agreement, then the taxpayer, the non-resident taxpayer, would suffer, and he would lose the benefits of tax treaty. That is the most undesirable consequence. And UK also, the same issue, UK also has opted for as how Netherlands, UK also, they might have a different criteria to decide the control and management or poem. We have a different criteria as per our own guidelines. They may not match. This would keep the taxpayer in a huge difficulty. When it comes to Singapore, Singapore made a reservation. Reservation means it said, no, I am not going to accept this amendment through MLI. We are not preferring, as I mentioned to you. Thereby, India-Singapore tax treaty is not impacted, though India has accepted. Unless both the treaty partners accept the same option, then only that will modify the existing provision of a tax treaty, that is called a covered tax agreement. If it is not done by both treaty partners have different options, then the existing provision prior to MLI would continue to apply, would continue to exist. So as far as Singapore, the tiebreaker rule, that is the poem, continues to be a tiebreaker rule. So this is what you need to bear in mind. And poem is a very, very important concept. And friends, I would like to mention that there are many companies, to my knowledge, floated. I'm coming to the practical discussion. There are many companies who have floated their subsidiaries outside without proper knowledge of law, without proper guidance, and they're virtually managed from India. All such companies should be treated as residents of India on the basis of this poem concept. you need to really carefully take all the precautions under the POEM guidelines and establish commercial substance in that foreign entity and ensure that active business is carried out by that company outside. Otherwise, you run the risk of facing the POEM trigger, thereby making such foreign subsidiary as an Indian resident, and the entire income of the foreign subsidiary would be brought to tax. So this is the most important thing, because now GAR provisions are in place, POEM is there, the international taxation is now truly complex, and unless we are gearing up and updating ourselves with this concept, it would be very difficult, and more so in the light of MLI. All these changes you must bear in mind to ensure that proper structuring is happening with respect to Indian companies which are outbound. There are many Indian companies, software and pharma and other engineering industries, where they are trying to open their subsidiaries outside. And you must be very careful. This POEM concept must be borne in mind in all the structures. You must revisit all the structures and ensure that you are POEM compliant, and ensure that POEM is not triggering for your subsidiaries which are really operating outside. And you must ensure that the control and management, or the effective management, is outside and not in India. So friends, this is what I thought I would bring to your attention in this presentation. And I'm very thankful for a very patient hearing, running through this most critical concept of POEM. And I would be really pleased to take up questions in the limited time available. Thank you.
Yeah. Thank you very much, Prasad. What I will do is, there are few questions which have come, and as Chaitanya has also not joined now, I would read out the questions for the benefit of the members who can't see, and then you can answer them. Are you fine with it? Yeah. So I'm first starting with the question of Unnati Sharma. Unnati Sharma, what in case foreign company is being provided management consultancy services through an Indian company, then whether Radharani holding case law be referred, and what would be the POEM status?
If at all the man, see, I have just kept this video off for better bandwidth. So I think my voice is clear.
Yeah, voice is clear, Prasad.
Am I clear? Yeah.
Yes,
so,
yes.
No, the question, as I understand, management consultancy services are given by India. And what type of consultancy? That is what we need to look at. See, if at all it is a management support, the back-end operations, that is fine. If at all you are doing the critical functions sitting here, deciding what business activity needs to be done by the foreign company, how it has to operate, how it has to progress, then definitely the POEM is in India and not outside. The outside foreign company must have the wherewithal to conduct on its own. That is the reason many a time, if at all you have some directors for that foreign company, one of them must be stationed in that country, let it be Singapore, Mauritius, or any place. If at all he is stationed there and is operating the company, then definitely we need to come to the conclusion that the effective management is outside and not here. If at all the managing or operating directors are stationed in India, definitely it would give an adverse inference that it is being managed from India. So the management services, we need to see what is the nature of service. See, if it is just a support services like accounting, legal support, that is fine. If at all it is the critical management support of taking decisions, which line of product you need to pursue in that market, what is the type of terms and conditions, and which target groups needs to, if all nations, critical nations are happening from India, then it would amount to having POEM in India, and that foreign company would be susceptible for the POEM risk.
Thank you, Prasad. I go to the next question of Ramkrishna Vedula.
Yes.
He says, sir, I think India is non-member of OECD. Are any of the recent recommendations by OECD binding, oblique will be considered by our direct tax department?
See, you are putting a very broad question. What I mean to say, I do agree that India is only an observer and not a member of OECD. That doesn't make any difference because the OECD G20, it's part of G20. OECD G20 inclusive framework has come out with the action plans under BEPS. BEPS is the anti-avoidance measures. All the anti-avoidance measures, anti-abuse measures proposed by BEPS action plan have culminated into a multilateral instrument which is signed by as many as almost 100 countries. As of now, or little more than 100, I'm not sure, but India is one of the countries who have signed. India is one of the first countries in the first batch of signatories in June 2017 itself. Thereby, MLI, the impact of the OECD G20 BEPS action plans have already been brought into MLI, which MLI we have signed, which is the reality, which is modifying the existing tax treaties. So that way, that is what we need to see. See, the commentary given by the OECD Model Convention may not be binding because many a time courts have held that it's not binding on the cases to be decided, but sometimes they are of persuasive value and definitely they are considered by the honorable courts also. So that is the reason whether you are a member or not a member of OECD does not matter much. We need to see how MLI has impacted you, how the BEPS action plans which have culminated into MLI have impacted the existing or modified the existing tax treaties. That is what we need to examine.
Prasad, thank you. The next question definitely is not with respect to the topic, but when people see you, they try to get some of the other questions also solved. The next question is from Rajshekar Reddy.
Okay.
Sir, if payment is made to NRI in INR, whether 15 CB is required or not? So
Whether
when you
you
go
make-
into perfume shop, you just take some of the perfume and put it on your clothes, no?
See, whether you make INR payment or dollar payment, when once you make a payment to a non-resident, 195 springs into action and you need to comply with 195 provisions. Once 195 means 15 CP, 15 CA, everything would apply.
Thank you.
It is out of syllabus actually.
I know, but yeah, I told you, in a mall when we can always go to fragrance shop and take some perfume.
Yes, yes.
The next question is from Pallavi Tuppada.
Yes.
Sir, poem applicability is triggered if the turnover exceeds 50 crore.
That's
So
right.
whose turnover should exceed, whether the outside entity or the Indian entity?
I would treat it as outside entity only because the applicability is for the residency is being found out for the outside entity and not for the Indian entity. See the circular number 8 of 2017. So I would definitely treat it as applicable to the outside entity and not the Indian entity.
So Prasad, that finishes the questions from today. And before I just request Deepak to take over, Prasad, my customary thanks to you. So let me just, can you just stop the share screening for a minute?
Okay, I'll stop sharing.
Chaitanya sir has come.
Yes, sir.
Great. So Prasad, thank you very, very much. In fact, today, I think it was beautiful session. Many topics you have just gone into details and tried to explain. And thank you very much for the wonderful session. So what I do is that I welcome Chaitanya sir, the speaker of the next session. And before I hand over to Chaitanya sir, may I request Banu Narayan Rao, past chairman, Hyderabad branch, to kindly introduce Chaitanya sir, post which he can just take it over.
And in fact, I need to compliment Mr. Chaitanya, my good friend, who has suggested this topic at length, because this was not originally considered by me, and we had a discussion before. Drawing up the program agenda. Then he is the one who suggested that poem is more appropriate, because that is where we need to, drive this topic effectively to our fraternity. That is what. So I really thank Chaitanya for his suggestion on the poem topic. Thank you.
Thank you from Team Hyderabad also. Banu, if you can just take.
Thank you, Chairman. Friends, we have with us a person who secured 8th rank in the Karnataka state at the PUC level, then graduated in commerce with first rank from Mysore University, secured 47th All India rank in CA Intermediate, and 15th rank All India in CA final, and topped Karnataka state in the results in that year. He did his articleship at PricewaterhouseCoopers, Bengaluru, and had his industrial training at Hindustan Lever Limited, Bangalore. And he practiced as a chartered accountant for 14 years, specializing in taxation matters before shifting to the Karnataka High Court to practice as an advocate over there. Chaitanya means intelligence or pure consciousness. We have with us today Chaitanya KK, a chartered accountant who is presently practicing as an advocate at the Karnataka High Court. A niche area of taxation like international taxation requires enlightened people like Prasad and Chaitanya to talk to us and make us understand the nuances involved. Chaitanya lectured at IIM Bangalore, MDP of ICAI, and he presented papers on income tax and VAT at various metros and other cities and forums of ICAI, BCAS, CTC, Mumbai, IFA, Society of Auditors, AIF, TP, BCIC, etc., and is also a member of study group of ICAI for framing guidance note on transfer pricing. He co-authored 2 books, one being Tax Holiday under Sections 10A and 10B, published by Walters Kluwer, and the second book is Decoding Section 5, published by Oakbridge, and authored a book on special economic zones. He contributed articles for the ITR, the Chartered Accountant, BCAG Journal, Taxman, CTR, and many other legal journals and publications. He deposed before the Committee on Direct Tax Matters headed by the Honorable Justice A.P. Shah on the levy of MAT on FIIs. And he is also the country reporter for India for IFA Seoul Congress 2018 on withholding tax. And today he'll be speaking to us on the basic concepts of MLI. Friends, we'll all benefit from his Gnan Ki Jyoti, which will flow like Gnan Ki Ganga. So be ready to reap the benefits and accept the full flow of knowledge that will flow from Chaitanya in a short while from now. Over to you, Chairman.
Thank you, Banu. Your introductions are always a pleasure to listen to. Chaitanya sir, welcome once again to Hyderabad, and over to you, sir.
Thank you. My sincere thanks.
Chaitanya sir, just before you start,
Yes.
we will be here only, but our videos will be off because of the bandwidth, to just get a better bandwidth.
Okay.
I'm here
Right.
only, so any point, I'm here, don't worry.
Right. I would at least keep my video on so that I don't speak like feel like speaking to the wall. So
Please be.
yeah, right. My sincere thanks to Hyderabad branch and Mr. Prasad for inviting me to give a talk on MLI. And Mr. Prasad, in fact, sounded a note of caution that I'm not supposed to make MLI complex. I am supposed to make MLI look much simpler. And in the on the humorous part of it, he's been a little unfair by expecting a lawyer to make things simpler. A lawyer is known to make simple things more complex. So, so I'll have to be actually unlearning what I learned as a lawyer. uh, Anyway, it's a good opportunity to interact with the learned delegates from Hyderabad branch, which is not new to me. I would know quite a few of them over there. And it's certainly my pleasure to be amidst you this evening. As mandated to me, I would not I would at least endeavor not to make MLI look complex. I'll try to make as simple as possible, because the topic is essentially the basic concepts of MLI. And the 1.5 hours of time what I have, you would appreciate, may not be sufficient to cover the whole gamut of MLI, but the endeavor is to create and generate some sort of an interest in you, and to remove the myth that MLI is something which is very very complex and is left to only a few elite consultants and not to the ordinary practicing chartered accountants. I will assure you that those of you who have digested the Indian Income Tax Act, you would not find it difficult to digest MLI. The only difficulty you will have in MLI is like it appears to have been drafted in French and translated into English. So therefore, you would find it a little difficult to, because your way of reading English is a little different from, the way it's drafted. That would possibly require you to read it a couple of more times. I'm telling out of our experience, because, certain articles of MLI, to honestly share with you, in my initial 3-4 readings, nothing entered my head. And for a while, I was wondering whether I'm really getting older, not in a position to understand the text of it. But then reading it over and over would definitely help you to crack it. And it's not a rocket science, not that only those who are in, much bigger firms alone could handle. Be rest assured, any one of you, given your intent and work, should be able to, crack any issue arising out of MLI. So with this, I would very briefly take you through the journey of MLI. And the genesis of MLI is found in, BEPS actions, which, OECD and G20. India is part of G20. They've been working on this since, 2007 onwards. They've identified about 15 actions to address the concerns of tax avoidance. So shifting of tax basis to the low tax jurisdiction or no tax jurisdiction. And very interestingly, most of the mischiefs which you would notice in these actions, the BEPS actions, they're already addressed in India. So Indian tax laws are very robust. The administration mechanism is quite strong, and checks and balances are well in place in India as compared to certain of the European countries. In fact, I would rather say that the BEPS actually would benefit the European countries more than the more than our country, because our country has a very strong tax system. Of course, we may have difficulty in having the adjudication mechanism done faster. The judiciary may be slow here, but then it's quite, I would say, very, very, mature decisions do come from the Indian judiciary as compared to, many other countries. So most of these the concerns are essentially not relating to India, but India, having been part of this G20, wholeheartedly embraced the actions, and one of the very aggressive participants in these proceedings. And these actions, 15 actions, were brought out in 2015. Out of these actions, some actions will have to be dealt with, domestic law amendments. Some actions will have to be dealt with through treaty mechanism. Now, those of the actions which could have been dealt with treaty mechanism, which you couldn't have addressed through the domestic law amendments, it would have been very cumbersome if these treaties were to be bilaterally negotiated and modified. You are aware that the double taxation avoidance treaty is a bilateral agreement. So if all these treaties were to be brought back to the negotiating table and will have to be amended, would be an Herculean task and extremely time consuming. And in these aspects, time is the essence, because every day running would mean some of these countries losing millions of dollars by way of, taxes because of these BEPS concerns. For this reason, the 15th action plan, that is Action Plan 15, provided for a very wonderful system of MLI. See, multilateral instrument is not, new. We had MLI in other aspects, not in tax aspects. We had MLI kind of an instrument, multilateral instrument in other aspects. One of the examples could be Vienna Convention, also is a multilateral instrument. And we have in, crimes and other aspects, the multilateral instruments which are in vogue. So in the matter of taxation, we have, MLI being brought in, because we as chartered accountants or lawyers in tax practice wouldn't deal with other laws, may not be conversant with the other MLIs. But the MLA that has come in now is something which is very important to us, because it affects our way of understanding the double taxation avoidance treaty. So what I was trying to say is, out of these various actions, some of the actions which could have been handled only through the treaty modifications, because bilaterally amending each treaty would have taken a hell of a lot of time, they have brought out a very novel method of multilateral instrument, which at one shot would have amended all your double taxation avoidance treaties. So that's the objective of MLI, as is evident from the explanatory statement. Now, a very brief timeline. As I've said earlier, you have the BEPS action plans, which were issued in the work started in February 2013, and you had 15 actions being identified in July 2013 and being published in 2014. Then they started MLI negotiation. As I've said earlier, of these actions, some could have been handled only through the treaty mechanism, for which purpose MLI was brought in. And the negotiation started, as early as in February 2015. And the historic event took place in November 2016, 24th of November 2016, where they actually concluded the negotiations and adopted the text of MLI, as well as the explanatory memorandum. Like how you will have your finance bill having an explanatory memorandum, even MLI also has an explanatory memorandum and an FAQ. So those of you, when you read your MLI, get any doubts, you can definitely refer to the explanatory memorandum as well as the FAQs, which are part of this publication. And the most important day is 7th of June 2017, when about 70 governments, India being one of them, met in Paris and did the signing ceremony of MLI. Then it provided for a ratification. So the ratification mechanism started from 2017 onwards, and the MLI came into force in July 2018 with effect from 1st of July 2018. And you had, the various countries started preparing synthesized text, which I'll explain you what it is. And the first conference of MLI took place in September 2019. Now, there is another parallel aspect which you need to know, that, as I said earlier, you have 15 actions. Out of 15 actions, some could have been dealt with by making amendments to domestic tax law. Some could have been dealt with only through the treaty. I will very, briefly run you through the various actions and how they are sought to be addressed. If you look at Action Plan 1, which will address the tax challenges of the digital economy, it is not something MLI deals with. So it has to be domestically dealt with. So that is why you will find explanation 2A, explanation 3A, all these having been introduced into section 9.1, significant economic presence, the additional attribution aspects which are brought in by explanation 3A by Finance Act of 2020. You had equalization levy Avatar 1, which was brought in into Finance Act in 2016. And you had an equalization levy in the case of e-commerce operator at the rate of 2%, which e-commerce operator will have to pay. That is brought in by way of equalization levy 2.0 by Finance Act of 2020. So you would know that the action plan, action 1, is addressed through domestic tax law amendment. If you go to the action 2, which deals with hybrid mismatch arrangements. The hybrid mismatch arrangements are situations where you will have, like double deductions, triple deductions, double non-taxation. The country which pays it would call it as, dividend. The country which receives it would call it as interest, and vice versa, whereby, you will have either double deductions happening or neither country levies tax on it because of hybrid instruments, hybrid entities, transparent entities. So this is sought to be dealt with by MLI Article 3. And you will have the case of stateless persons or dual resident entities who are residents in both the states and end up claiming foreign tax credit in both the states. This also is sought to be dealt with by MLI. So neutralizing the effect of hybrid mismatch arrangements, that is action 2, is sought to be dealt with by 2 of the MLI articles, 3 and 4. Then when it comes to controlled foreign company rules, CFC rules, action 3, that is presently not dealt with either by MLA or by domestic tax law. The Indian tax laws do not have the CFC rules, although the Direct Tax Code of 2010 wanted to have it. But you are aware the Direct Tax 2010 never came into effect. Then, like you had the thin capitalization, action 4. That is dealt with domestically by section 94B, which provides for disallowance of interest beyond, like 30% of EBITDA in respect of interest payments made to overseas associated enterprises. That is domestically dealt with. Then you will have action 5. See, action 5, what is happening is, like different countries will have different, method of the rulings that are coming. It could be tribunal decisions, it could be the higher judiciary like High Court or Supreme Court, it could be authority for advance ruling, it could be APAs, multilateral, bilateral, unilateral. What is happening is the positions which different countries take would not be known by all. So this lack of information flow is causing, people to leverage on this gap of availability of information and get the best of both sides. So this is creating some problem, for which purpose they have suggested that there has to be exchange of information on tax rulings, like across automatic exchange. And you will have the OECD G20 carrying out peer, reports, where they'll keep examining whether the countries are compliant with this. Are they, allowing all these decisions to be put into a mechanism of automatic exchange? So this is again not dealt with by MLI. This is dealt with by domestic action. Action 6 is the pillar of MLI, the most important, action of all the action plans. It deals with preventing the granting of treaty benefits in inappropriate circumstances. So this would deal with a variety of things. And most of these are sought to be dealt with by the MLI. For example, like you will have the foreign tax credit mechanism. There are mischief there in the exemption system, which are sought to be dealt with by Article 5 of MLI. And you have, treaty abuse, where you select a particular country's residents solely with the intention of, avoidance of tax and getting the treaty benefit. An American investor would deliberately use, Netherlands treaty, where you will set up a shell company in Netherlands and would want to make use of Indo-Netherland more beneficial regime as compared to Indo-US regime. So these are sought to be dealt with by, Article 6 and 7 of MLI. And dividend transfer transactions dealt with by Article 8 of MLI. and capital gains from alienation of shares deriving their value principally from immobile property, Article 9. And Article 10 of MLI would deal with a triangular situation where you will have the state of residence, you will have the state of source, and you will have a P located in a third state. And you would want to get into a situation where neither country would levy tax thereon. So that also is thought to be dealt with by Action 6. And when it comes to MLI, Article 10 of MLI. Then you will have a situation of, people trying to use a DTAA to overcome the right of, the country to levy tax on its own residents. I will explain this a little later in the context of impact of Article 11 on in the Indian context. So, but this is also part of Action 6, which is sought to be dealt with by the MLI. So as you've seen now, you would notice that the critical part of MLI, you could see the basis as Action Plan 6. So Action Plan 6 is a beautiful document. It's imperative for you to go through Action Plan 6. And as you read these articles, more particularly Article 5, 6, 7, 8, 10, and 11, it's of immense advantage for you also to keep Action Plan 6 side by side. It's a big document. It's a little difficult to spend your time. Now that you have left behind your tax audits, high time you get back as a student and take a print of Action Plan, keep it in your car, keep it in your briefcase, keep this MLI document with you, just keep reading. It helps. The reason why it helps is you would also know as to various attempts made across the globe for avoidance of tax. So you may wonder who will come to me for MLI, who would come to me on this international taxation. That is not the issue. You may get a lot of tax planning ideas, particularly if you look at Action 2, which I was trying to tell about hybrid instrument, hybrid entities. Although India has reserved it and has not applied MLI Article 3 insofar as a hybrid entity and hybrid instruments are concerned, it's very, very, advantageous for you to run through the various examples of which are found in Action 2. You would know how, countries would go for, different measures to achieve the avoidance of tax. It's very interesting for a tax practitioner to see. It should be of interest to you to see how a person seeks to avoid tax. What is the measure? I'm not suggesting or encouraging you to, get into those steps. What I'm only suggesting is you should be mindful of the efforts. You should be mindful of various measures which a tax evader takes, whereby you should be able to advise your client appropriately. What are the risks involved? So that is the reason why, I would reiterate at the cost of repetition that Action Plan 6 is the most important, action of all action, all 15 actions, and most part of MLI, which you're going to discuss today, would be towards implementation of Action 6. Then you will have Action 7, which is, certain efforts made by taxpayers to avoid the triggering of permanent establishment. In this regard, you have, MLI Articles 12, 13, 14, and 15 dealing with the same. Then you have Actions 8 to 10 dealing with transfer pricing outcomes with value creations. You'll have intangibles, difficult to value intangibles, hard to value intangibles. You'll have situations of the R&D, contract R&D, or typically where you ostensibly appear to be working on a cost plus model, but you are actually creating value. Though the patents that get created would be registered in the name of the associated enterprise abroad, who would be, reaping the benefits of the gains on alienation or transfer of the same. Actions 8 to 10 say that even the person who has worked on a cost plus mechanism should also be entitled to a, cut in the cake. So very interesting thing. Then you will have measuring and monitoring the developments of BEPS, which is something which OECD G20 will take. You will have mandatory disclosure rules, and you will have Action Plan 13, that is transfer pricing documentation and CBCR, all that master file and CBCR, which you would have seen in Section 92D, read with Section 286. is a domestic action. It's a domestic action. It's not through the MLI. That is why you will find Income Tax Act itself dealing with that. And the 14, Action 14 is important. It talks about MAP and the corresponding adjustment. You may have seen Article 9 of any treaty, which will say that it's a transfer pricing issue, where it's permissible for one country to restate the income of its taxpayer if it has dealt with like an associated enterprise where there is a participation in the capital control and management. A typical 92 kind of a situation. But then if one country like enhances the income of one entity, its associated entity, if that were also to pay tax in its country, it will create economic double taxation. See, we are dealing with economic double taxation, not the juridical double taxation. The difference between the two is, in the case of juridical double taxation, I myself will pay tax twice. We are not dealing with that. We are dealing with an economic double taxation. For example, me and Prasad are associated enterprises. A certain amount is disallowed while computing my income. 1 crore is disallowed as an expenditure, which I have paid to Mr. Prasad, but his country will tax him on that 1 crore. So this is a case of an economic double taxation. That is why you have something called corresponding adjustment. So corresponding adjustment, etc., you would see them having been, and arbitration, etc., you would see them being handled in MLI from Article 16 to 26. So Article 15 is the one which has suggested that the MLI will have to come into play. So just to summarize, what I was trying to explain to you is there are 15 actions. The 15th action talks about MLI. The first 14 actions will identify various concerns. Some of the concerns are to be handled in the treaty. Some of the concerns will have to be handled outside the treaty, but domestically by making amendments to Domestic Act. I have tabulated to here that which of the actions or which of the concerns are being addressed by domestic law amendments and which of the concerns are being addressed by MLI. So you would notice that MLI is not some sort of an omnimedicine. It will only deal with some of the concerns, as I have tabulated and explained to you. It doesn't deal with all the BEPS concerns. It only deals with some of the BEPS concerns. Now, there is another thing that's called minimum standard. What is this minimum standard? OECD and G20, when they got together, when they decided to implement these BEPS actions, see, if they were to come and only discuss and go away without doing anything, it will not mean anything. Because they will all come and say, yes, we'll have to do it. When they go back to their respective countries, they don't do anything. At the same time, not everything can be mandated to them because they have their own sovereign concerns. And this is a loose group. The OECD and G20 is a loose group. It has no sovereign sanction as such. So it cannot be 100% implemented. At the same time, it cannot be left completely to the discretion of the participating countries. So they have decided, okay, we will agree on some minimum standard. These minimum standards, no compromise. All OECD and G20 people have to adhere to minimum standard. Rest of the concerns need not be minimum standard. We will leave it to your choice. See, I have already told you about 14 actions, 14 concerns. Out of these 14 actions, not all are minimum standard. Only some are minimum standard. And rest are discretionary. Those which are called minimum standards, which are agreed to as minimum standard, have to be necessarily implemented. There is no escape from minimum standard. This is what you have to understand. Now, what are the minimum standards? Minimum standards are found in only these actions. So I told you about Digital Commerce Action Plan 1. It is not minimum standard. Hybrid entity, not minimum standard. You have Action 3 CFC. It is not minimum standard. That is why you see India having not done anything there. Action 4 thin capitalization, not a minimum standard. But when it comes to Action 6, Action 5 is a minimum standard, where you have to necessarily share all your judicial pronouncements, all your, advanced pricing agreements, whether unilateral, bilateral, multilateral, all will have to be shared. Your authority for advanced ruling decisions will have to be shared. When it comes to Action 6, there are some minimum standards which you'll have to do. And when it comes to Action 13, the CBCR is being implemented across the globe. So that's because it's a minimum standard. And when it comes to Action 14, the dispute resolution mechanism, mutual agreement procedure, the corresponding adjustment, minimum standard. So these minimum standards cannot be compromised. The rest to the discretion of respective jurisdictions. You will appreciate that India has not only adopted minimum standard, which anyway it is bound to do, it has also accepted most of the other concerns of the BEPS action plans. India has been in the forefront. So if you see India's position when it filed both its provisional filing as well as the final filing of instrument of ratification when it joined the bandwagon of MLI, you will notice that India has accepted most of the MLI articles. So that is where it stands. Now, look at how many countries are part of this MLI bandwagon. See, the adoption of MLI took place on 24th of November. The first high-level signing ceremony took place on 9th June 2017. That is when India signed. And also, deposited a provisional document of notification and ratification. But it deposited a final document on 25th of June of 2019. And as of 15/1/2021, about 95 countries, as per the OECD website, 95 countries have become part of MLI. About 95 jurisdictions have become part of MLI. Now, out of these 95 who have become part of MLI, about 54 countries, MLI has already come into force, including India. So you still have balance which have agreed but are yet to file their instrument of ratification. See, unless and until you file your instrument of adaptation and the ratification, you would you would be part of MLA, but MLA would not come into effect. In order that MLA will have to come into effect, you have to sign those final documents and have it deposited with the depository of MLI at OECD. So out of 95 jurisdictions, as of now, only 54 have become are the countries where the final filing has taken place and the MLA has come into effect. Now look at Indian position. So India has entered into treaties with about 94 countries. See, there are about roughly 200 plus jurisdictions across the globe with whom India deals with. Out of this 200 plus jurisdictions, double taxation avoidance agreements have been entered into only with 94. Out of this 94, only 60 have adopted MLI. That means balance 34, MLI will not trouble them at all because they are not part of MLI bandwagon. They are not part of those, 95 countries worldwide who have entered the MLI bandwagon. So out of 94, only 60, so far as India is concerned, are part of the 95. Out of 60, only in respect of 40 countries as of date, or some maybe effective 1/4/2022, the MLI has come into effect. Balance 20, they are still taking time. As far as India is concerned, it has done. The other 20 countries, they are yet to file their instrument of ratification. But one fine day, they will also be part of this. So after some time, once the life settles here, you will notice that out of 95 double taxation avoidance treaties, only 60 will have been impacted by MLI. Balance 34 will not be affected by MLI. They continue to remain as their existing double taxation avoidance agreements, and your understanding of the same will continue unchanged. Now look at this. I'm giving you the position of all this 94. First 10 are part of 60, but then there is some mismatch. So, it will be resolved. Next 4 also, there will be some mismatch. Balance 46. Together, it will come to 60. If you see 10, the bold ones, 10, 4, and 46 will make it 60. So 60 are the ones with whom we will have MLI. The other countries will not have. For example, Germany. Germany said, no, I don't want India as part of MLI. So you're out of it. Though India is keen to have Germany as part of MLI. Hong Kong said no. we don't want India as part of MLI. Mauritius also has said, no, we don't want India as part of MLI. So, and you have 28 jurisdictions, they are not even part of MLI bandwagon. You have Bahrain said, no, we don't want. Your Switzerland, your Oman, they all have said, no, we don't want India as part of MLI. Why would they not want India as part of MLI? Because they have decided, okay, we'll negotiate bilaterally with them separately. Let them not be brought into the multilateral platform, because there could be very unique issues. There could be very unique issues between India, maybe, and Switzerland, India and Germany, for which reason they do not want to, it to be brought on the multilateral platform. They would want to deal with it bilaterally. Now, some of the important countries who have kept India out of MLI would be Mauritius, would be China, USA, Germany, Hong Kong. Some examples, The USA is anyway not part of MLI bandwagon. They have said, get lost with MLI. We will not want to be part of MLI. So Germany and Mauritius are very much part of MLI, but they have kept India out. So when you deal with these countries, your existing DTAs remain unaffected. Now, this is an important point for you. These are 40 countries with which MLI has already come into effect, except some of them where you will see the dates here, where Albania, for example, will come into effect from 1/4/2022. Out of these 40 countries, close to about 30 plus countries, MLI has already come into effect as of 1/4/2020, and some of them will come into effect from 1/4/2021, and a few of them will come into effect from 1/4/2022. They already filed their instrument of ratification. These dates are certain. So whenever you deal with these 40 countries as of date, you have to be extremely careful. That is when you will have to see whether MLI has impacted the DTAA with these countries. Other countries, you don't have to worry about MLI. Only these 40 double taxation avoidance agreements, you will have to worry about them right now. Now, see, I have said, I kept saying MLI, double taxation treaty. So you may wonder what is this, how it works. See, how MLI works is, it works along with your covered tax agreement. What is this covered tax agreement? As I've said earlier, out of 94 double taxation avoidance agreements, 60 are covered by MLI. That's why they are called covered tax agreement. Covered tax agreement is nothing but a double taxation avoidance agreement, which is one of those 60. You have entered into DTAA with 94. Of the 94, 60 are DTAAs, which are also called as covered tax agreements. Now, how do you read a covered tax agreement normally without MLI? You take that agreement, you see if there is any protocol, if there is any notification, then you read it. Now, what has MLI done? MLI has amended this treaty. How it has amended this treaty? It is not going to strike it off and write something over it. It would rather have to be read alongside the CTA. For example, if you take the Indo-France treaty, you have the Indo-France treaty, double taxation treaty, keep that. Then you have a protocol, keep that with you. Then you have the MLI. Not whole of MLI. Only some parts of MLI would have impacted Indo-France treaty. So you may ask me, why is not MLI completely impacting the treaty? This is the beauty of MLI. See, you appreciate that MLI will have to recognize the sovereign rights of respective jurisdictions. They cannot impose, because, see, for example, the Indian government and the Parliament of India is sovereign. So MLI cannot tell you have to necessarily do it. So there has to be some sort of a, it is just a very, very persuasive statement that, okay, why don't you consider it? So they all have agreed, as I've said, minimum standards will definitely do. Non-minimum standards are left to the discretion. So what countries do is, when they deposit their instrument of ratification, they tell, I want this article of MLI, I don't want this article of MLI. This is called reservations. So not all countries need adopt whole of MLI. there is a mechanism of countries choosing. I want this article. I don't want this article. For example, Article 4 deals with resolution of dual residency. India has opted for it. But out of 60 CTAs, about 31 of them have said, I don't want Article 4 of MLI. Meaning what? Even for India, it will not apply. So unless both countries are having consensus that yes, we will have MLI Article 4.1 brought into our respective treaty, there has to be consensus. If there is lack of consensus, that MLI will not trouble you at all. I'll give one more illustration. Look at hybrid entity. Article 3 of MLI deals with it. What India has said, I don't want MLI 3 with any of the countries. So no matter whether how many of our countries would have wanted MLI 3, as far as Indian treaties with them are concerned, MLI 3 will not apply. MLI 4, though India has opted, out of 60, about 31 have said we don't want. That means only amongst 29 balance who have said, okay, I want MLI 4. India also has said MLI 4. MLI 4 will apply. Similarly, when you go to MLI, 7, simplified limitation of benefit, or MLI 8, MLI 9, whichever article you go, except the minimum standards. In case of minimum standards, all will have to agree. There is no escape from minimum standard. I've already told you what a minimum standard. The rest of the articles, they have their choice. How do they exercise their choice? By reservations. So that means the country to country position could vary. So it becomes complex for you to understand and see whether for India, France, what will apply, what will not apply. As I said earlier, it's not a rocket science. You can always go to OECD matching database, a database which gets updated on a day-to-day basis. You can go there, you can exactly know the India's position. That apart, India has deposited its final instrument of ratification that is available both in OECD website as well as the income tax website. There also you would know how it will apply. And accordingly, you can rework the Indo-France treaty, for example. That is one method of doing it. Another method of doing it is to develop synthesized text. What is synthesized text? Just take the original treaty, take the protocol, take that part of MLI which affects Indo-France treaty and rewrite the treaty so that you will have one document. Otherwise, you'll have to look at 3 documents, existing Indo-France treaty and the protocol and that part of MLI which has affected the Indo-France treaty. That makes it a little complex reading. That is why they have suggested, okay, we will develop synthesized text. So synthesized text is nothing but creation of a single document with reference to each country. So what there is, the OECD has brought out a guidance for the development of synthesized text, and they have said, they have defined what is it, and but there's no legal obligation to do it. It is not a legal document. It is only a convenient document. So in the explanatory memorandum to MLI, in paragraph 13, they have very clearly said, developing synthesized text is not a prerequisite for application of MLI. You may prepare for the sake of convenience if you want to. If you don't want to prepare, it does not mean MLI is not applicable. So the delegates have to carefully understand that the synthesized text is only a convenient document. That's it. It has got nothing to do with the interpretation, etc. So ultimately, interpretation will have to be on the basis of the treaty, on the basis of the protocol, on the basis of MLI, as has been adopted by India vis-a-vis that particular country. Synthesized text is only going to make it easier. That's it. So that's what they have said. It's only as a guidance to aid the readers. Look at the bold ones written in red here. However, for legal purposes, the paragraph 3 of page 9 of the guidance on development of synthesized text issued by OECD clarifies, for legal purposes, the provisions of the MLI must be read alongside the cover tax agreement as they remain the only legal instruments to be applied in the light of interaction of the MLA positions of the contracting jurisdictions. So now, what India has done is, it has issued about 25 synthesized texts for the sake of convenience. That's it. But my suggestion is, you don't have to depend completely and wholly on the synthesized text. If you have any doubt, please go back to, as I've said earlier, the treaty end MLI position and understand it yourself, because we have found in the course of our study that some of the texts in the censor text are not exactly in conformity with the covered tax agreement as amended by MLI. Now, structure of MLI. So this MLI has, as many as 39 articles. So you will have, like I have just given the table here. Different articles deal with different aspects. I have also, indicated it ago that how some of these articles could be traced to some actions of BEPS action plans. Anyway, this PPT will be shared with you, so you could always, use it as reference. So this is, something which I wanted to tell you before we get into the hardcore part of MLI. Now, before I, proceed further, I would want to take some questions because, you may have some very, very basic questions before we get into, understanding how the MLI has impacted the taxpayers in India. So, Chairman, sir, can you ask me some questions if there exist any questions?
Yes, sir, there are 3 questions which have been posted.
Yeah.
I'll just read it for you. The first question is from Deepak Swankar. He asked that, sir, if an OCI card holder who is a resident in India now, but not Indian, but having professional income in foreign country, should we go for audit as receipts are over 60 lakhs? No amount is transferred to India.
I'll stop this question right now. This is completely out of syllabus. The questions will have to be restricted to the MLI, because the other questions, if we start answering, in the limited time horizon, we will not be able to address the topic. So I would request the delegates to restrict their questions to the topic of the discussion.
Correct. I think the next question from Abhiroop Bhargav. 1 second. One second. The next question is from Abhiroop Bhargav. GAR and principal purpose test. How these have to be considered post MLI?
I will
subset of.
Yeah, I will separately explain it. That I have it's part of my slide, and I'm going to explain this separately. Yeah.
Okay. And there's one more from Vedula. Sir, will the CBCR reporting get affected because of MLI?
No.
For instance, Germany doesn't.
The answer is no, because I'll straight away answer it. As I've already indicated, CBCR is part of Action 13, which is to be addressed to by the domestic tax law compliance, and the MLI does not deal with it. I would request the delegates to raise questions on what I've discussed so far. See, I'm going to discuss a few more aspects of MLI when we get into hardcore aspect of MLI. But article by article, the important articles, I will anyway take you through them. So far, for about a good half an hour in the past, I've explained, the basic functioning of MLI, basic understanding of MLI. In this regard, you have any questions, you can ask me. Otherwise, I will proceed.
Only one question, which I still am not deciding, but you can take. Sir, is MLI better model or data as in earlier regime?
No, there are 2 different things. See, basically, the original document has to be DTAA, Double Taxation Avoidance Agreement, because it happens through a bilateral negotiation. Countries' authorities, the other countries' authorities will sit and thrash. They will have their mutual economic concerns, mutual social concerns. They have a different rapport. So that is the platform. But when we enter into double taxation avoidance agreements with several jurisdictions, as I've said earlier, 94 jurisdictions have entered into, people start, making use of gaps in these, double taxation avoidance agreements, and then start exploiting these gaps for their unreasonable gain. And they start playing mischiefs. For this purpose, there were identified concerns. And some of these concerns are sought to be addressed by MLI. See, MLI is not a substitute for DTAA. Please understand this carefully. MLI is not a substitute of DTAA. MLI has no existence on its own. It is a parasite. It has a parasitical existence. It only go to the extent applicable, go and, it will sit in your DTAA. So the question cannot be which is better. There is no such thing. Question is, what is that you have to refer to? As I've said earlier, you have to refer to DTAA as amended by MLI. That's it. Both coexist. Yes, sir.
I think that's all about the questions, sir, so far.
Wonderful, sir. Now we'll go to some of the important articles of MLI. And here I'll be very, very brief and, explaining only to the extent it is relevant. And I'm not going to, get into complex aspects of it because it would require, much detailed deliberation. And, I'll have to make you run through the text of articles and explain. So I would not be doing it. I'll make it look as simple as possible. Now, if you look at article MLI 4, what is MLI 4? See, MLI 4 says, in the case of a non-individual who happens to be dually resident in both the countries. Take one example, for the sake of convenience, I will take Indo-France example across. It will not apply to individuals. As if you are an individual and you happen to be resident in terms of Article 4.1 of the Indo-France Treaty, there's a tiebreaker test at Article 4.3, you are aware of it, how it has to be resolved. If you happen to be resident of both the states, then we go on various, nationalities, center of vital interest, habitual abode, etc. The various tests that are available. We are dealing with non-individual, a company, for example. If there is a company, there is a partnership form which happens to be resident in both the countries, India as well as in France. Now, what Article 4.1 says is, you cannot allow a person to be resident in both the countries. It has to be resolved. The competent authority of India and competent authority of France will have to sit and eventually decide whether this company is to be resident of India or a resident of France. They have to decide by mutual agreement. If, for example, they are not able to decide by mutual agreement, then the person cannot get the treaty benefit. So he is lost the treaty benefit. So that's the effect of Article 4.1. But treaty benefit, are all the treaty benefits lost, or can some one or two treaty benefits be doled out? This will depend on the competent authorities. They may decide, okay, we will not give all the treaty benefit, but we'll give one benefit, we'll give two benefits. It is all left to their discretion. If they don't have agreement in respect thereof, no treaty benefit at all. So the effect of MLI 4 is that if you are not an individual and you happen to be resident both in India as well as in France, then before the treaty is applied to you, the competent authorities will have to first decide which country's resident you have to be taken to be. If they decide, then fine. They may treat you as resident of India. If so, you are not a resident in France, and vice versa. If they are not able to decide, then you as a non-individual taxpayer will not get the benefit of Indo-France Treaty. So that's what it says, shall not be entitled to any relief or exemption from tax provided by the CTA. You're out of it. You will not get foreign tax credit. You will not get exemption. You will not have, various concessional rates of taxes that would be available. You will not have the protection of, payment of tax on business profits where you don't have a PE. Treaty benefit itself is not available. In fact, if you look at US treaty, already it is there for a company. If you look at Article 4.3 of the Indo-US Treaty, it already has a similar clause. It says, I'm just giving the example of Indo-US Treaty. As I've already indicated, US is not part of MLI bandwagon. But the existing Indo-US Treaty provides somewhat similar to MLI 4.1. So what it says is, by paragraph 1, a company is a resident of both contracting states. Such company shall be considered to be outside the scope of this convention. Of course, in the case of Indo-US Treaty, it will apply only to company. But if MLI 4.1 is made applicable, it will apply to non-companies also, provided they are not individuals. So that's about Article 4. Before I go to Article 5, any questions on Article 4?
No, sir, no one.
Yeah. Delegates may feel free to ask questions even later. So some of them may forget to ask questions. So that's why at every point in time, I'll be taking a pause, just to see if there are any questions that are arising here. Now, I'll then move to Article 5.
They are requested to pose the questions in Q&A so that it's easy for us to identify and answer.
Exactly, correct. Now let me go to next article. Application of methods for elimination of double taxation. Now here, if you look at MLI 5, Article 5 MLI, see, you are aware of avoidance of double taxation. Normally what will happen? How is double tax avoided? See, you pay tax in one country by reason of residence. You pay tax in another country by reason of source. So double taxation could be avoided by different mechanisms. One is by one country agreeing not to tax at all, where they decide the tax jurisdiction. Okay, I would not tax, you only tax. Another method is, if you tax, I will exempt it. So the resident country says, if the source country taxes, I'm going to exempt it. Another situation is, both will tax, but the residence country will give you foreign tax credit. So to deal with this, see, what is happening is, there are some mischiefs happening, not with respect to Indian treaties, with respect to the alien treaties, in respect of these mechanisms. They wanted to streamline it. So in option C, they have said in MLI 5, wherever there is an exemption, it has to be replaced by credit method. What is the difference between exemption and credit? As I've already told you, I'll give you an example. If you look at the Indian treaties, there are 4 countries, Bulgaria, Egypt, Slovak Republic, and Greece, where we have exemption regime. What does it mean? If you're an Indian resident, you earn income in Bulgaria, $1 million, that will not be included in Indian income at all. That's called exemption regime. Under the foreign tax credit regime, it will be included, but you get a credit for tax that you have paid in Bulgaria to the proportionate extent, not resulting in refund. So that is called foreign tax credit method. Exemption method is never considered as a proper method, a healthy method of avoidance of double taxation. So therefore, India opted for option C. But Indian treaties, 94 treaties, what you have, only 4 countries we have this exemption regime. So normally what should happen? This exemption in these 4 treaties should be replaced by credit mechanism. But interestingly, out of these 4, Greece and Bulgaria said, no, we want exemption method to continue. That is called reservation. India said, I want exemption in respect of all these 4 to be substituted by credit mechanism. But out of 4, 2 have said, no, we don't want it at all. So Greece and Bulgaria said, we don't want credit method. We want to continue with the exemption method. That means what? The Indian treaty with Greece, Indian treaty with Bulgaria, though India wanted option C to replace the existing exemption method by credit method, it will remain unchanged because those 2 countries have not agreed. Now, when it comes to Egypt, they have said, yes, we will permit India to apply option C. We will not apply option C, but let India do for its resident. So that's why for Slovak Republic and Egypt, when you examine in Egyptian treaty with India and the Slovak treaty with India, the existing exemption regime will be replaced by foreign tax credit. Now, if you go to Chinese treaty, China is not part of MLI so far as India is concerned. But China and India have entered into a protocol where the existing exemption regime in Indo-China treaty is replaced by the credit mechanism. So therefore, only in respect of 3 countries, you have exemption system replaced by credit system, Slovak, Egypt, and China. With respect to Greece and Bulgaria, as I've said earlier, your exemption regime will continue despite India wanting it to be replaced because those two jurisdictions have said no. So this is how the MLA functions. It is not enough for you to choose. There has to be consensus in choice. Then only it will apply. Yes, sir. Any questions on this?
Yeah. Now, one question has come, sir.
Yes, sir.
From Unnati Sharma. If you just take, can we say MLI provides credit method only, no deduction method also?
No, can you repeat the question?
Can we say MLI provides credit method only, no deduction method also?
As I said earlier, MLI in Article 5 has brought out three options. Okay. As far as India is concerned, we are not concerned with the first two options. We are only concerned with option C, where the existing exemption method is to be substituted by the credit method. So, in fact, the querist is right in saying that MLI Article 5 essentially advocates credit method. It does not recommend exemption method. He is correct, but that is not mandatory. As I've explained earlier, it is not mandatory. For example, the two countries like Greece and Bulgaria said, we want to continue with the exemption method. We don't want MLI on that method at all. So therefore, while MLI wants to say and advocate only the credit method, countries have a choice. And this is not a minimum standard. This is a discretionary, standard. It's not a minimum standard, not mandatory. Yes, sir.
That's all, sir. I think only one question was.
Yes. Now we go to the next article, MLI 6. See, MLI 6 says, whatever you take any treaty, it will have a preamble text. Any act, for example, you take, it will have a preamble. Like an act, even the treaty has a preamble. The preamble essentially brings out the purpose and intent of the treaty. Now, earlier, most treaties had only the preamble text, which is given in red, intending to eliminate double taxation with respect to taxes covered by this agreement. One entire intent of the treaty was to avoid the double taxation. But they have realized that the treaty should serve not only the case of avoidance of double taxation, treaty also should not create opportunity for non-taxation or reduced taxation through tax evasions or avoidance. It should not encourage treaty shopping. So that is why they have brought in Article 6 that your existing preamble text should be substituted by this to necessarily provide that the purpose of the treaty is not only to avoid double taxation, but also it should not create non-taxation. See, the avoidance of double taxation is one thing. What about avoidance of even single taxation, which is not good? Everyone has to pay tax. You cannot, expect a person to be earning money but not paying tax in any jurisdiction, which is not right. When, everyone else is contributing, it's not right for someone to, exploit the loopholes in the system and not pay the tax and not contribute to the, development of society. So that is why it is considered that even non-taxation is harmful. A reduced taxation through avoidance and evasion is harmful. Treaty shopping is harmful. That is why they have amended the very intent and purpose of the treaty by mandatorily substituting the existing preamble text. And mind you, this is a minimum standard. This is a minimum standard. All those who have agreed with MLI will have to have this. They cannot reserve this article. Now, apart from this text, whatever they have, they can add one more aspect if they want to, that is desiring to further develop their economic relationship and to enhance the cooperation in tax matters. See, I don't know if you have heard of tax-paying credit. So there is something called tax-paying credit. In a tax-paying credit, there could be a situation where there may not be taxation in both the jurisdictions, but then that is consciously granted to develop economic relationship and enhance cooperation in tax matters. So if you want, you can have this also added to the preamble text. Now, you may ask me, even honestly, till I started getting into this MLI, I had not bothered to read the preamble text. No one actually bothered to read the preamble text because, after all, what it stated, intended to eliminate double taxation. That's it. Now, they've added a few more things, that double taxation cannot result in non-taxation or reduced taxation through tax evasion or avoidance. It should not encourage tax avoidance. It should not encourage treaty shopping. These have been added now in the preamble text. Why is it important? The importance lies in the manner in which the preamble text has to be read. See, there is something called Vienna Convention. India is not part of Vienna Convention, but nonetheless, the worldwide, including Indian courts, have tended to follow Vienna Convention. There, Article 31, one of the Vienna Convention says, any like treaty, international treaty, it shall be interpreted in good faith, in accordance with the ordinary meaning to be given to the terms of the treaty in their context and in the light of its object and purpose. And for the purpose of the basic rule, the context of the treaty would include its preamble. Now, what is the objective of this? Henceforth, whenever you read any double taxation avoidance treaty which is part of MLI, which is amended by this, wherever there is interpretation issue, so you will have to interpret various things in the treaty, like how you will have to interpret an income tax act. You also will have to interpret various terms of the treaty. And any interpretation, one of the cardinal principles of interpretation is the literal reading, keeping in mind the object and purpose, which is also called as literal reading tempered by purposive reading. You can't read a statute as a dead letter without having the background of its object and purpose. Any piece of legislation is intended to secure some object and purpose. So interpretation of that piece of legislation has to be towards achieving the object and purpose and not towards, like defeating it. This is one of the cardinal principles of interpretation. Same thing will apply to treaty. Earlier, when we were interpreting treaty, if there is any, like ambiguity, we would have resolved it in favor of ensuring, okay, let us avoid double taxation. Now, it is not just the avoidance of double taxation, it is also avoidance of tax evasion. So now, whenever there is an interpretational issue, you also have to keep in mind, if you interpret it in a particular manner, will it create an opportunity for cheating on taxes? If so, you have to shelve that interpretation. So this is the beauty of Article 6. See, Article 6 by itself will not achieve anything. It only changes the context. It adds to the context the important purpose, that is not to facilitate cheating on taxes, not to create opportunity for non-tax or lower taxes through tax avoidance or tax evasion, including treaty shopping. So whenever you read any article, any term in the article, any article of the treaty, henceforth, after it is amended, you have to keep in mind this and accordingly interpret it. That's why I've said it's a minimum standard, because a treaty is only intended to help people to do legal things, meaningful things, and not to let people avoid the taxes. Now look at, I'll just give you an example how Indian treaty gets amended because of this. You look at, for example, Mauritian treaty. See, existing preamble text, if you see, the Government of Republic of India, the Government of Mauritius, desiring to conclude a convention for the avoidance of double taxation and the prevention of evasion, prevention of fiscal evasion with respect to taxes on income and capital gains, and for the encouragement of mutual trade and investment. have agreed as follows. This is the existing preamble text. To that existing preamble text, you need to add all this now. Intending to eliminate double taxation without creating opportunity for non-tax and reduced taxation, including treaty shopping, all this will get added. Whatever is existing text, this will get added. Some may overlap, it does not matter. For example, if you see for avoidance of double taxation, you find both in the existing text as well as in the added text. It does not matter. Just because it comes twice, it's not going to alter the situation. Now look at the Australian treaty, another example. See, right now we have only avoidance of double taxation and prevention of fiscal evasion. That's all. Now that is going to be substituted by the whole lot of MLI Article 6. So this is how it works. And if you look at Finance Act of 2020, the last Finance Act, they've even amended Section 90 there. They have brought in words. The very words which you find in Article 6 of MLI are also now statutorily introduced into Section 90. So corresponding amendment has been made as well in Section 90 capital A. Yes, sir. Before I proceed further, any doubts?
No questions have been put, sir.
Very interesting. See, if no questions are put, it could give rise to either of the two alternative versions. One is, it is so very well understood that there cannot be scope for any question. The other one is, it is not at all understood that the questions cannot arise at all, because it's not explained at all properly. So which of the interpretation do I make? Yes, sir.
I prefer to go with one, because even though I'm not much into this, I'm still trying to get these things. But nice, sir, I think questions will come. Don't worry.
Okay, right. So I'm only joking. So now we'll go into next article. This is a very important article. In fact, one of the queries had asked a question about the domestic GAR and the PPT. So the heart of MLI is seen in Article 7. The heart of MLI is seen in Article 7. It talks about prevention of treaty abuse. What it says? It says, a treaty benefit which you are otherwise eligible, you will not get it if obtaining the treaty benefit was one of the principal purposes of any of your arrangement, transaction, etc. So it's called PPT test. What is PPT test? Principal purpose test. How does it work here? If it is found that one of the principal purposes of your arrangement or the transaction is to secure the relevant treaty benefit, then you will not get the treaty benefit. Meaning what? Does it mean that you should never get the tax benefit? They don't say that you should never get the tax benefit. They should say your decision is not to be principally governed by tax benefit. It should be governed by economic considerations, not only by tax. Take, for example, a US investor wants to invest in India. So if he would invest in India, he has to invest in India directly. Instead, he chooses Netherlands platform. For example, if you have just read the news item about a week before, Tesla has registered a company in India. Where is Tesla based at? USA. But which route it took to invest in India? A Netherlands route. Why? Because it has found that the Indo-US DTA tax regime and Indo-Netherlands DTA tax regime, the latter is far better. You have a lot of protections from capital gains, etc. if you are looking at Indo-Netherlands treaty as compared to Indo-US treaty. That is why Tesla has chosen to invest in India through Netherlands. Now, Tesla now has to establish, if tomorrow they want to take the Indo-Netherlands treaty benefit, now they have to establish that obtaining that benefit is not one of the principal purposes of their arrangement of investing in India through the through Netherlands platform. Why did they choose Netherlands to invest in India? They should bring out non-tax consideration for it. Then only they'll be successful. If they don't bring out the non-tax consideration, If the authorities decide that Tesla has invested in India through Netherlands only to take the benefit of Indo-Netherland Treaty, then Indian authorities may deny the Indo-Netherland Treaty. They'll see through the transaction and say, no, I'm going to apply Indo-US Treaty. I'm not going to apply Indo-Netherland Treaty. So this is the effect of PPT test, which is stated so in Article 7.1 of the MLI. If you look at OECD Model Convention 2017, you will find the similar language used. Now, that apart, it's like GAR test. PPT is like a GAR test. What is GAR? General Anti-Avoidance Rule. GAR and PPT are synonyms. They are applicable to all transactions, all arrangements, but they are very subjective in nature because it's a subjective call. I don't have any objective parameters on which basis I decide that one of the principal purposes is to secure the tax benefit. It is my call. If I am the tax officer and you are Tesla, Netherlands, who has invested in Tesla India, and there is some capital gain which has arisen, do you want to claim exemption under Indo-Netherland Treaty? You come to me, I will decide. There are no set parameters, there are no set objective reasoning. I just decide and I'll apply it to anything and everything. That's why it's called general anti-avoidance rule. It applies to all and sundry items, but it is highly subjective. At the same time, we have something called SLOB, Simplified Limitation of Benefit Test. It is like SAR, Special Anti-Avoidance Measure. It will not apply to all situations. It will apply only in given situations. And there are some objective parameters laid out, which you will apply. So your decision will be more reasoned when it is the case of simplified limitation of benefit. Whereas your decision would not be as much reasoned when it is the case of PPT test. I'll repeat again. PPT is a general test, applies in all situations, but it is a subjective test. SLOB is a special test. It will apply in special situations, but it is not as subjective as PPT. It is a very objective test where there are some set guidelines which I have to follow before I trouble you. Now, the question that arises is, should both apply? The answer is yes, both coexist. While the PPT test applies in all situations, SLOB will apply in some special situations. Even if SLOB test is satisfied, if you fail the PPT test, you will not get the treaty benefit. You have to satisfy both the tests. The general PPT test will have to be satisfied in all situations. And in those special situations, you also have to satisfy SLOB test. Satisfaction of general PPT test will not preclude the operation of SLOB test, or conversely, satisfaction of SLOB test does not preclude the operation of PPT test. Both will coexist. This is a point which will have to be clearly understood. However, when it comes to minimum standard, PPT test is a minimum standard. It's a mandatory standard. All countries have to adopt it. Whereas SLOB is an optional standard. When it comes to India, while India, I've told you, has 60 CTAs, correct? To which MLI would apply. All the 60 CTAs, PPT test will apply. However, the SLOB test, Simplified Limitation of Benefit Test, which are contained in MLI Article 7, Subarticle 6 through Subarticle 13, out of 60, it may apply hardly to about 12 countries. Rest of the countries said, to hell with SLOB, we don't want it. So therefore, we have to be concerned about SLOB test only with respect to those 12 jurisdictions. Rest of the countries, SLOB will not apply. But PPT test will apply because PPT is a minimum standard. So this needs to be understood. Now, what is this SLOB test? I'll very briefly tell you what is SLOB test. See, what SLOB says is, if you want the tax treaty benefit, you have to be a qualified person. Who is a qualified person? That is stated in MLA 7.9. See, if you are an individual and you are a resident in France, you are a qualified person. Now, if you are a company, take Tesla example only. Now, who has Tesla invested in India? Through a company in Netherlands. Now, whether that company in Netherlands, it may be resident of Netherlands because it is incorporated there. That is not the criteria. Is it a qualified person? For which you have to see whether in the last 365 days, at least for half of the last 365 days, at least 50% of shares in the Tesla Netherlands are they held by a listed company in Netherlands? Are they held by individuals who are resident in Netherlands? Or is that company in Netherlands a listed company? If that company in Netherlands itself is a listed company, it's a qualified person. If it is not a listed company, at least minimum 50% of its shares should be held by a listed company in Netherlands. So now take a case where Tesla Netherlands, which has invested in India, though it's a resident in Netherlands, if 100% of its shares are held by US companies or US investors, it is not a qualified person. So if it is not a qualified person, it will not get the benefit of Indo-Netherlands Treaty. But then there is an exception. They say, okay, don't worry. If you're not a qualified person, it is not that the life is lost for you. We will give you two more opportunities. One, active conduct of business test. If you satisfy the active conduct of business test in terms of MLI 710, then we will give you the benefit, though you are not a qualified person. Let us say you will not be able to satisfy the active conduct of business test in Netherlands. Then also they'll tell you, don't worry, you are neither a qualified person nor you have active business in Netherlands. But if you satisfy the test of equivalent beneficiary under MLI 711, we will still grant you the treaty benefit. See, I'm not going to complicate now because all these terms are complicated. Like how you will have to understand whether you are an equivalent beneficiary, what is the active conduct of business test. We will not have time in this occasion to be discussing this. I'm just giving a broad outline. So what is the purpose of active conduct of business? Active conduct of business is, are you genuinely located in Netherlands or you have only a postbox address in Netherlands? What is a postbox address in Netherlands? You have just a company registered in some consultant's office. You don't do any activities. So that means you're not into active conduct of business in Netherlands. You have to be doing business in Netherlands. And not only that, your business in Netherlands should be substantial as compared to your business in India. De minimis activity in Netherlands will not qualify you. So that is the meaning of active conduct of business test. So if you fail the test, then you may possibly look at equivalent beneficiary test. What is the equivalent beneficiary test? I'll give an example. Let us say a Mauritian company has invested in India. The shareholders in Mauritian company are from the Netherlands. So Mauritian company is not a qualified person because all its shares are held by residents of another state. However, and active conduct of business test also is not satisfied. However, they may satisfy equivalent beneficiary test whereby had Netherlands resident directly invested in India without opting through Mauritius, had he directly invested in India, would he not have got the benefit which he would have got through Mauritian entity? If it is so, then there is no mischief being played here. Because Netherlands treaty is definitely much better than Mauritian treaty. Why would you invest in India through Mauritius? Though investing directly would have benefited him better, obviously for non-tax reasons. That itself will establish that he should get the treaty benefit with reference to Indo-Mauritius. So this is the logic of equivalent beneficiary test. Now, if you fail all these tests also, the doors are not shut. You can then go to the competent authority and plead before them that yours is a very special case. Your PPT is not to avoid tax. and get the tax benefit. It is in line with intent and object of the treaty, and therefore, despite you not being a qualified person, despite you not satisfying the test of active conduct of business or equivalent beneficiary, you may still be bestowed the benefit of the tax treaty. In such case, in terms of MLI 712, the competent authorities may still choose to give you the benefit. See, this is how MLI 7 works. So I have just tried to make it as simple as I could within the given point in time. Now, let's come to the next important question. One of the queries asked a very pertinent question. We have domestic GAR, plus we have PPT of Article 7.1 of MLI. Which one would apply? See, even if you look at Section 95, which talks about the domestic GAR in Chapter 10, read with Section 96, which defines what is an impermissible avoidance arrangement, IAA. It says the principal purpose is to obtain the tax benefit, plus there is a test of 4 sins under Section 96. So, if you look at Section 96 of income tax, it has a composite test. One is the principal purpose is to obtain the tax benefit, and there are 4 sins. So you have to satisfy one of those 4 sins and the PPT test. Then domestic GAR would apply. Whereas when it comes to MLI 7.1, there is no question of composite test, just one test. That is one of the principal purposes. Whereas if it is one of the principal purposes, domestic GAR will not apply. In order that the domestic GAR will apply, it has to be the principal purpose. If you are able to bring out one more principal purpose, which is non-tax, you're out of domestic GAR. I'll give an example. Let us say you have 4 principal purposes. The 4 principal purposes, out of which 3 principal purposes are to get the tax benefit. One is non-tax principal purpose, right? You're out of domestic GAR. But Article 7.1 of MLI will trouble you because it says one of the principal purposes. And not only that, let's take one example. You have just one principal purpose. Take another example. Only one principal is to avoid the tax or to get the tax benefit. MLI will hit you, but GAR may not hit you because it is a composite test. The principal purpose test plus test of 4 sins. You may not satisfy the test of 4 sins under Section 96. Domestic GAR will not apply. Now the question that would arise is, if I am able to overcome domestic GAR, can they trouble me under MLI GAR? If I'm able to overcome MLI GAR, can they trouble me under domestic GAR? See, the impact of these would be different. For example, if it comes to domestic GAR, you have the grandfathering benefit. You don't have an MLI. 2, if the tax benefit would not exceed 5 crores, you will not get hit by GAR under the domestic tax law. But MLI will not have any threshold exemption. Thirdly, domestic tax law cannot be invoked in a case except by intervention of the approved authority under 144 BA. That approved authority will have a retired judge as one in the panel. Whereas when it comes to MLI, you don't have such checks and balances. The local Charlie can, exercise the power and trouble you. So now an important question that would arise to me is, between the two, which one do we do? Are we hit by both? Are we hit by either of the two? Does the department have a choice? First you try this MLI, if not try GAR, or try GAR, if not try MLI. These questions would arise. In my understanding, because of the effect of Section 90, subsection 2, capital A, which is overarching, what it says is, Section 90, subsection 2, capital A says, notwithstanding anything contained in Section 90, subsection 2, the provisions of Chapter 10A, that is domestic GAR, shall apply to the assessee, even if the same are not beneficial to him. Meaning what? Your existing DTAA, which is amended by MLI PPT, is subordinate to Chapter 10A, domestic GAR. And domestic GAR will override the double taxation avoidance agreement amended by MLI 7.1. Meaning, as a taxpayer, you can insist that the department cannot invoke MLI 7.1 in your case because of the overreach of domestic GAR provisions under Section 90, subsection 2, capital A. So my answer to this question is, you are always covered by domestic GAR. You are not covered by PPT test of 7.1. But same logic would not apply when it comes to SLOB test. As I said earlier, SLOB test is a SAR, so special avoidance test. That would coexist with the domestic GAR, wherever it applies. Out of 60 countries with whom we have the CTS, hardly about 12 countries we have the SLOB being applicable. Those SLOBs will continue to apply with the domestic GAR. So MLI PPT will not apply. Yes, sir. Now, any questions before we proceed further?
Yes, sir. Just a second.
Yes, yes. So we are also running out of time. We have to, I think I have another 2 minutes to go.
No, sir, you can not. Whether all the tests under SLOB are mandatory to clear or any one of it?
No, there is an order. There is an order that will have to follow. First, they'll check whether you are a qualified person. If you are a qualified person, you don't have to do anything else. You are in under the SLOB framework. If you pass the qualified person test, no further test would be applied. You are past SLOB test. If you're not a qualified person, then they'll give you multiple options: active business conduct test or equivalent beneficiary test. Either of the two you can satisfy. Then you are past the test of SLOB. So like this, they work, in alternates. There is an order that is followed. Yes, sir.
That's all, sir, I think.
Okay, now I don't have much time left now because, there are far too many articles. I would take you, Article 8 is not very important because, it will apply the concessional dividend tax rate under the treaty, that the source country can levy not more than 10%, etc. If it comes with a condition that the recipient of dividend is a beneficial owner and is a company, and that fellow should have held shares in this Indian company X percentage, 20%, 30%, whatever, then only he will get the concessional rate. If there is any such condition, that condition will have to be satisfied throughout the 365 days, he should have held the shares. So that's the condition which is there in MLI 8. Now, when it comes to MLI 9, so MLI 9 would deal with the capital gains which you would have from alienation, transfer of shares, but the shares derive their value from immovable property located in the other country. Then the country where immovable property is located will have the right to tax the capital gain on transfer of those shares, because though it is called as share, value is essentially immovable property. Many a times what people may do, so even in domestic tax practice you would have seen, so you have the land bought in the name of a company, you don't sell the land. If you have to sell, you rather sell a share, because sale of share is better than sale of land. But essentially what you have sold is land through the mechanism of the share. So that is what is Article 9 about. And it says, wherever you sell such shares, and if any time during the 365 days, those shares derived at least 50% of their value from the immovable property located, say, in India, then India will have the right to tax. So earlier, what people used to do is to, they would have, sold immovable property just before the sale of share, whereby they would have avoided this test. So that is why they have brought in this saying that if any time during 365 days, if you have held the immobile property that company, and the share in that company, its value is, being contributed to the extent of not less than 50% by such immobile property, then Article 9 would apply, and India would have a right to tax. So it's more particularly 9(4), where they have had two thresholds. One is any time during 365 days, and minimum 50% of the value to be derived from the immobile property. Then we have other articles, which I think for want of time, I may not deal with that at this point in time. So if the chairman kindly consents, I'll stop and take questions, and then, we'll close.
Sir, as of now, because we have been clearing the questions, I don't see any question in the Q&A.
Yeah.
Okay, if anything important, which if you can cover in that time.
Okay, I could possibly, tell about Article 11, which is an interesting article. This would apply. See, many times in a double taxation treaty, we use the terms "it may be taxed." We also use the term "it shall be taxed." We also use the term "it may also be taxed," "shall only be taxed." Different terms are used. Now, in one decision, R.M. Muttaiya's case, Karnataka High Court decision, which was approved in Azadi Bachao Andolan and understood as approved in Kulandagan Chettiar's case, where it was understood that the words "may be taxed" should be understood as "shall only be taxed." For example, if an Indian resident is having a permanent establishment in France, it is provided that the profits attributable to permanent establishment in France may be taxed in France. So the courts in India understood as "may be taxed" means can only be taxed in France and cannot be taxed in India at all. So this was, enabling Indian residents to claim exemption in respect of the profits which may be taxed in France. So this was creating issues. This is a classic case of using the double taxation avoidance treaty to take away the right of India to tax its own resident. So you are a resident in India, you have to pay tax in India on global income. And the treaty only says may be taxed in France. That doesn't mean India should not be taxing it. So that is sought to be undone by Article 11. Article 11 says the India's right to tax its own resident cannot be taken away by inferences. It can be taken away only by explicit clause in the treaty. For example, if we take Indo-Bangladesh treaty, there is a clear agreement in the treaty that if an Indian resident has a PE in Bangladesh, profits shall only be taxed in Bangladesh. That will remain. But this misunderstanding or misconstruction of "may be taxed" as "shall only be taxed" will not apply after MLI 11 comes into play. So that's it, sir. I think Article 12, 13, 14 will take time. I don't think I'll be able to deal with it in 2 or 5 minutes. It will take much longer time. So we can discuss this on a different occasion.
Thank you. Thank you very much, sir. Thank you for the excellent, thank you for sharing time with us and just trying to understand and make a basic presentation. So we could see the chartered accountant Chaitanya rather than Advocate Chaitanya today. Thank you very much for that. And my request, sir, if you can just switch off, stop the share screening.
Yes.
I would like.
I'll do that.
Sir, in the times where we cannot see you in person and you're talking to us virtual, so at least we thought that we'll have a small virtual thank you note for you. So kindly accept it, and whenever you come to Hyderabad, this would be waiting for you to be received. Okay. So thank you very, very much, sir, for being with us. May I request Deepak Ladda, Secretary, Hyderabad branch, to propose vote of thanks and also inform about the tomorrow's sessions. Thank you.
Thank you, Chairman, sir, for giving me an opportunity to offer vote of thanks for the day one closing ceremony of 2-day conference on international taxation. A very useful session, which we many chartered accountants wanted to specialize in the international taxation era. Is the first day is coming to end. wherein both the speakers have comprehensively and simplistically covered the topics in detail. Sir, I, on behalf of entire Managing Committee of Hyderabad branch of Southern India Regional Council of Institute of Chartered Accountants of India, extend warm vote of thanks to the distinguished speakers of the day, CA PVSS Prasad sir and CA KK Chaitanya sir, for covering the topics of POEM and MLIs respectively. I also thank each and every individual, more than 200 members, for attending the webinar. Friends, I request you to kindly join on the same time tomorrow, that is 5 p.m., wherein another two expert speakers will share the knowledge with us. CA K.R. Shekhar sir on equalization levy and Advocate Sudarshan Rangan sir on the latest case laws on the international taxation. I also thank immediate past chairman Bhanu Narayan Rao sir and treasurer of the branch CA Chinna Sitaram Reddy for attending the program along with us. Thank you, sir. Till that time, take care. Good night.
Thank you, sir. Thank you, everyone. Thank you.
Thank you.
Thank you, sir.
Right, friends, see you tomorrow. Thank you.
Thank you, sir.
Thank you, sir.
I'm ending the session.
Sure.
Right, sir.
ACS మీరు రేపు శేఖర్ ది ఇంట్రొడక్షన్ మీరు చేస్తున్నారు.
Okay, sir. Okay.
शेखर सर మీరు చేయండి. दीपक अगर फिर आप सुदर्शन सर का कर ले सकते हैं.
ठीक है सर, अगर कोई नहीं आया तो मैं कर लेता हूँ.
नहीं, तुम ही कर लो, कोई नहीं आया, नो चॉइसेस मत